it falls to wealthier households who may be less inclined to spend out of marginal income anyway.
Okay, thanks so much, Jennifer. Thanks for your time. Jennifer McEwen of Capital Economics with the latest thinking on the European economies. Now, keeping you up to date with news from around the world, here's the first word with Leanne Gerrans.
Hi, Anna. In Italy, the mafia's most wanted boss has been caught after 30 years on the run. Italian military police arrested Matteo Manessa Del Nero at a private clinic. Manessa Del Nero has been convicted for dozens of murders, including those of 2 judges. Now, here in the UK, teachers may join hundreds of thousands of employees who have gone on strike for higher pay. The National Education Union will announce the results of the strike vote later today. Meanwhile, the House of Commons will debate anti-strike legislation. In Germany, Defence Minister Christine Lambrecht has stepped down after a series of missteps and days of speculation about her future. It is a blow to Chancellor Olaf Scholz's government. Lambrecht's departure comes as Berlin is debating whether to supply Ukraine with tanks to fight Russia. U.S. Treasury Secretary Janet Yellen will hold her first face-to-face meeting with Chinese Vice Premier Liu He. That will happen tomorrow. They'll meet in Zurich. The surprise announcement follows a November meeting between President Joe Biden and President Xi Jinping. That led to a modest thawing of relations between the 2 governments. Global news 24 hours a day, on air and on Bloomberg QuickTake, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Anna.
Leanne, thanks very much. Leanne Gerrans with the latest First Word news. European equity markets then are up by 0.3% this morning. We are nearly 3 hours into our trading day here in Europe. Of course, no trading in the United States because of the Martin Luther King holiday. But we're trading here in Europe, making modest gains. US futures, for what it was worth, pointing a little bit lower for Tuesday. This is Bloomberg.
Seeds, typically between the time you start and they get out in the farmers' fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
This is Bloomberg. Welcome back to Bloomberg Markets, a special edition of the program because of the Martin Luther King Day over in the United States. No trading stateside, but European markets are live, and we'll get an update on those markets shortly. Now, Bloomberg TV is live at the World Economic Forum in Davos in Switzerland all of this week. Bloomberg's Francine Lacroix has been sitting down with the CEO of the Qatar Investment Authority and began by asking about the importance of investing in tech.
In the whole area of technologies, we are interested. I mean, digitalization is a very important theme that we are taking. So we are investing in a software application that would play a role in the digitalization. And again, Francine, we are long-term investors.
Yes.
So we always really take a fundamental view into the sector and the theme that we are investing. Any correction in the market, it doesn't mean that we need to really play the tactic unless we would like to close a gap in our portfolio. But overall, we are a long-term investors and we take a long-term view.
What about banks? I know in the past you've been very invested in banks. It feels like it's almost a juncture because of higher interest rates for a lot of the banks.
See, financial institution is a very important pillar in the mix of the portfolio that we have in different markets. So ideally, in any exposure in any particular market, we would like to have a very balanced mix on the portfolio, whether this is a technology or financial institution or real estate, infrastructure. We always aim to have this balance. So investing in a financial institution will always be a theme for us. Yes. But we're also moving to a fintech, a digital financial institution, who is becoming very popular and a very important theme in our investment.
But this would be what, something only, mobile banking online only, or a big company with a big presence online?
It could be only online banking only, or an insurance, for example. So it could be anything. This is a very important, and again, it's line up with our important theme, which is digitalization is becoming very important for the humankind.
Yeah. How much do you like football? I know there's speculation on the back of the World Cup, probably unrelated, that the QIA is also interested in buying a big stake, a sizable stake in one of the big UK football.
See, I will be too general here. I mean, football's clubs and the sport is becoming very commercialized in a way. Especially now fans are looking into this as an experience. So they would like to go and experience and entertain themselves. At the same time, digitalization is becoming very important for this. So the business model of these institutions, let's say, are becoming very commercialized and very investment friendly. So you see even funds are becoming investors in this. And sovereign wealth funds are becoming also investors in some of the club. And you will not be surprised if we invest this. But again, we go into a very fundamental process and making sure that if we invest, this is a very commercially driven for our future generation.
But would this be chosen actually on paper? I mean, we know that Man U is maybe up for sale. We know that the Spurs are looking maybe to be sold as well or have a stake. Is this a stake? Would you buy a whole club? And if there are two equal ones, how do you choose?
It's a process that we go through. It's a discussion that we engage with the management. We have not made our mind yet, but this is a very commercially driven decision that we go through. And again, sport is becoming very important theme as well. People are engaged more in a sport, and digitalization is making it more attractive to investors as well.
And so do you see the Premier League changing in general just because it's so much more attractive, and we're seeing so many also American funds getting in?
Absolutely. Its league is becoming also another aspect, which is also I saw a lot of investors are investing in a sport league as well. So, this is, I think, a theme that you will see it very active in the coming years as well.
Is there anything else that we should be looking for? I don't know whether you're invested in crypto or some of the big themes. I mean, you're going after, things that people love. So this is, trophy assets. It could be football. It's technology. Twitter, certainly everyone's talking about it. Is there something else that you want to be in?
See, crypto, we had, it is the same view that we had before. We are not interested in the cryptocurrencies, but we are interested in the blockchain. So any application that's using a blockchain would be of our interest. This is a technology that came to remain. Sustainability is another theme that we are interested in, and this is also a theme that came to stay for a long time, and we would like to play a role in the transition that the globe is going through. And we are investing in all aspects, whether this is in the technology that play a role in the sustainability or in the infrastructure, renewables. The latest investment that we had, for example, with RWE, a German company that invests in the renewable, it ticked the box it ticked all the box for us. It's renewable. Yeah. It's a management that we like. It's an expansion in the U.S. market. So this is a very important theme as well that we will continue seeing us very active.
What's the ultimate trophy? Actually, is there one thing that, you know, if it came up at the right price, you would absolutely no doubt try and buy?
I don't have a name in my mind, but definitely, again, if this makes sense commercially, we will invest. Again, having a trophy assets, it's not really a theme it's always about how fundamentally makes sense for the future generation. That we manage the fund for them.
That was the Qatar Investment Authority CEO Mansour bin Ibrahim Al Mahmoud speaking with Francine Lacroix. That interview, one of the early interviews that we're bringing you from Davos this year. Davos in Switzerland, the World Economic Forum gathering of the wealthy and the powerful, and they have a lot to say on the prospects for 2023. We'll continue to bring you live interviews from the slopes of Davos. It's time now for a Bloomberg Business Flash, though, a look at some of the biggest business stories in the news right now. Credit Suisse reportedly plans to cut more than 10% of its European investment bankers this year. That is according to the Financial Times. Last year, the Swiss bank announced it would cut 9,000 jobs globally by 2025. The CEO of the Qatar Investment Authority says the sovereign wealth fund supports Elon Musk's vision for Twitter. We were hearing some of that conversation moments ago. Despite all of the turmoil, Mansour Al Mahmoud spoke to Bloomberg TV in Davos. The Qatar fund helped finance Musk's acquisition of the social media site. In China, DiDi Global has received the green light to start signing up new users again. That suggests the worst could be over for the ride-hailing giants. The crackdown on DiDi symbolized Beijing's campaign to rein in its powerful internet industry. And that is your Bloomberg Business Flash. So those are some of the top corporate stories that we're tracking for you here at Bloomberg. This is a special edition of Bloomberg Markets, of course, because Martin Luther King Day means no trading in the United States, but plenty of trading here in Europe. Let's check the markets for you right now. Stocks in Europe up by 0.3%. So we see some modest gains being made across Europe, up 0.2% on the FTSE 100, a little bit more than that, 0.3% higher than on the CAC in Paris and the DAX over in Frankfurt. So decent gains, modest gains perhaps actually more accurately across Europe. US futures, no trading today, as I said, but we will see trading tomorrow, and futures pointing down with that in mind. 0.3% weaker for NASDAQ futures. This is the picture then across the European equity space, but also some of the commodities in focus today. So natural gas prices down once again, down heavily here in Europe. This is the European benchmark, down by 11%. And so much of the concern over the Eurozone economy has centered on how it will cope, how it will manage with such sky-high energy prices. We've seen those energy prices come right down, partly to do with the weather, but also to do with successful efforts in Europe to try and replace Russian supply. And just today, we're seeing further comments by Germany, by Finland and others about new installations, LNG facilities that are helping to fill that gap where there once was Russian gas. Iron ore also on the back foot today, down by 2.8%. The Chinese increasingly looking at this market and talking about a regulatory clampdown. That's having an impact. And Brent crude down 0.3% at 84.99. Quick check on what's going on in FX. I'll linger really on dollar-yen. We're seeing the yen on the move today as we work our way towards a BOJ meeting this week that could be really important, or it might not be, depending on what they decide to do. We saw tweaks to policy around some of their policy on caps involved in yield curve control during December. Will we see something more drastic this week? Some people have that expectation. The market is pushing a little bit at the BOJ and testing the cap that it has on the 10-year yield, certainly. Will we see substantial change, or will we see further tweaks, or maybe nothing? Maybe just a stabilization of the markets is what the BOJ will want to do before we see a changing governor at that central bank. Coming up on programming today, Alberto Gallo joins the team next. This is Bloomberg.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
we've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Welcome to this special edition of Bloomberg Markets. US markets, of course, closed for Martin Luther King Jr. Day. I'm Tom McKenzie. Let's check in on these markets, of course, kicking off the week. On the front foot across European equities, building on a record start to the year. Gains of 0.3%. Expectations now on a Bloomberg survey from economists that the European Central Bank will keep hiking, but will then cut by the end of the year. There's a divergence there between those economists and the European Central Bank and officials themselves. In the US, of course, markets closed for Martin Luther King Day, a national holiday. Futures pointing lower by 0.2%. The context being that last Friday you ended up across Wall Street, gains that last seen the highest levels for US equities in about a month. We continue, of course, to assess the implications for the Federal Reserve. The yen is in focus for us today and throughout this week as we look ahead to that BOJ meeting on Wednesday. Of course, investors betting that maybe there will be some change from the BOJ around its ultra-loose monetary policy. Currently, you're seeing a little bit of softness for the yen, down 0.3%, but for the context, it is still close to levels last seen in May of last year, 128 on yen. And when it comes to iron ore, under pressure, down 4.6%. This is on news that officials in China are scrutinizing this market after a very strong run-up in iron ore prices, linked to expectations there will be more demand from the world's second largest economy as they continue opening up their having dropped COVID to zero. So that's a check on your markets in a couple of hours into the European session, and again on a national holiday stateside. Keeping you up to date with the news from around the world, then here is the first words with Angel Feliciano. Angel.
Tom, thank you. In Italy, the mafia's most wanted boss has been caught after 30 years on the run. Italian military police arrested Matteo Messina Denaro at a private clinic in Palermo. Messina Denaro has been convicted for dozens of murders, including those of 2 judges. The UK and the European Union are close to a deal on post-Brexit trading arrangements in Northern Ireland. They are nearing an agreement on customs. That's designed to reduce frictions between Great Britain and Northern Ireland since the UK left the bloc. U.S. Treasury Secretary Janet Yellen will hold her first face-to-face meeting with Chinese Premier Liu He tomorrow. They will meet in Zurich. The surprise announcement follows the November meeting between President Biden and President Xi Jinping. That led to a modest thawing of relations between the 2 governments. And more problems for President Joe Biden in the investigation of classified material. Additional documents have been found at his house in Delaware. Now the Republican chair of the House Oversight Committee, James Corner, wants the White House to release visitor logs from the home. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Angel Feliciano. This is Bloomberg. Tom.
Angel, thank you very much indeed. Right, let's go back to the markets and what is driving these markets across Europe, of course, on a day when the US remains closed. And we look ahead, of course, to that central bank meeting from the BOJ. Question marks about yield curve control. The team at Morgan Stanley saying the euro, though, European stocks can extend their lead, and it's been a record-breaking lead over the US, writing, quote, monetary policy will be tighter, fiscal policy will be easier, and value stocks will no longer play second fiddle to their growth peers. This backdrop should be more favorable for the European equity market than that of the past decade. European equities have added about 6.5% year to date. For more, let's bring in Alberto Gallo, Andromeda Capital CIO and co-founder, joining us. Alberto, good to have you on, of course, and for your perspective on European equities. Is the optimism around the European market justified at this point?
Well, we came from 2022, which was extremely pessimistic. There was a base case of a recession in Europe and even in the US. Today, we know that recession risk is much lower, that gas reserves are high, and most importantly, governments continue to spend, both in Europe and the US. We have very high deficits this year. There's also one factor that was completely unpredictable last year, which is the reopening of China. It's finally happening, and Europe is a beneficiary. So there is a lot of optimism on demand. Demand is stronger, but we can't forget that central banks are still there and inflation is still persistent. So, the optimism is there, but it's also being priced. And perhaps there's a little bit too much complacency on what central banks are going to do.
Okay, well, there's a lot to unpack there, but let's start with the central banks. And again, the Bloomberg survey of economists, and the survey suggesting that the ECB gets from 2% now to 3.25% before then cutting in the summer of this year. Is there a disconnect there with the way that economists surveyed by Bloomberg are looking at the trajectory for the ECB and what we're hearing from officials, and what does that portend as to the rate of increases that we're likely to get from the central bank in Europe?
The ECB is behind the curve. We have a very high level of inflation in the Eurozone, and the peak on inflation is around 6 months behind the US. So Eurozone inflation is going to peak, around the middle of this year. So we do think the ECB is going to go above 3%, but equally, even the US, the Federal Reserve, is expected to cut rates, in the middle of the year. Without a recession and with unemployment at 3.5%, we think that's pretty optimistic. So there's still a lot of liquidity in the system. Yes, some bubbles have deflated, but bond markets are very optimistic on central banks, either not hiking enough or starting to cut very quickly. So we see another round of surprise when central banks will have to be hawkish. There's currently a conflict. Central banks are saying I'm going to be hawkish, and and financial markets, bond markets are calling the bluff. And we think here central banks are going to keep the hawkish stance for longer. And that might create volatility later on. So that's the most important question really for investors. Are we going back to a world of low inflation and zero interest rates? And we think that's not the case. The short answer is no, the world has changed. We have more geopolitical risk, we have higher commodity prices, and we have populism.
Yeah, so those structural changes that you highlight for us in your note, one of those structural changes, as you nod to there, is the geopolitics and the relationship, of course, between China and its major trading partners. And you touched on the reopening of China. I just wonder if you're enthusiastic about the reopening impact, and you're based in Europe, you're exposed to Europe, how do you want to play that reopening story? Do you play it via European equities, or do you want direct exposure to China itself?
In general, I would say, like, in the world, we're seeing a shift from pure democracies and free markets towards state capitalism. And state capitalism or populism in its extreme version is pro-people, it's pro-spending, but sometimes it's also anti-capital. Now, China reopening will improve growth this year, but let's not forget that China has a balance sheet recession. It has a lot of debt in the private and public sector due to housing, and that's a problem that doesn't go away very quickly. But Europe is unlikely to go in a deep recession this year. And so where's the value? The value is in equities, but there's also value in credit. There's a lot of companies in Europe which are giving investors, high single digits or even double-digit yields, which is way higher than government bonds. So governments are spending at roughly 4 or 5% deficits. There's a lot more bailouts. Taxes are higher, which penalizes stocks. But there's also less probability of bankruptcy for a lot of companies, especially strategic sectors. So we like corporate bonds in Europe. We like credit, both corporate and banks, at this very high level of yields that investors can lock in and get a big advantage above inflation. So there's a lot of value in Eurozone credit today.
Okay, and switching focus to the US, but staying on credit, it's almost a consensus call that you want to get exposure to investment-grade US credit, long rates. Is that a consensus call that's looking, is that becoming a little overcrowded, that trade?
So obviously, last year was a terrible year for fixed income investors, with negative 15, 20% type returns in treasuries and in corporate credit. So everyone this year is saying, okay, this is the year of bonds. After such a bad year, we're going to have a good year. But it's not always the case. Perhaps, in our view, there's a little bit too much optimism that the Fed is done and they're going to stop at 5.25%. Inflation might be stickier. We see signs of persistent wage rises in the US. The UK is in a wage price spiral. So it's unlikely that central banks are going to throw in the towel and essentially say, mission accomplished at 5%. Yes, there might be a slowdown. They might have to cut later on, but we don't think it's a 2023 story. So as a result, we're pretty selective about where we go. The US market is very tight, both in rates and credit. We need wider spreads, wider rates. And in the UK, we have deteriorating fundamentals. So, we like to hide in the Eurozone where there's a lot of negativity priced in because of the war. So risk premium are higher. We're not going to the US and the UK or emerging markets yet because valuations are much tighter. But there will be entry points during the year.
Okay, you like to hide out in the Eurozone, at least for now. I'm assuming then, Alberto, correct me if I'm wrong, that the view that you take, you're in the camp of higher for longer when it comes to global rates, global interest rates. Does that mean that you have absolutely no appetite for value, particularly mega cap tech at this point?
So, this is essentially the Goldilocks trade. If you're a capital allocator today, you need to answer this question: are we going back to Goldilocks? We don't think that's the case. And the reason is that there's a lot of structural shifts. There's a shift in demographics. Millennials are becoming the median voter across democracies, and they're going against the oldest rule in politics, which is that people would become more right-wing, more conservative as they age. Millennials are remaining left-wing as they age. And essentially, this means that they're more pro-spending. There will be more fiscal spending across the US, across the UK, across the Eurozone. So that means persistent inflation. And the other thing that is structural is the US-China conflict. The Taiwan tensions are a focal point, but there is also China encouraging sales of oil in yuan, China spreading the digital yuan across the Belt and Road countries. And so the challenge to the US financial dominance is there. Yeah. This means more localized production, onshoring, and onshoring is more expensive. So there are a lot of reasons why We think that, there is persistent inflation. We're not back to Goldilocks. And, we need to trade this market this year and not be long investment grade, buy and hold, but be a lot more tactical and look for alpha.
Okay, Alberto Gallo, always appreciate it. Valuable insights. The need to consider that maybe these structural changes have led to the end of the Goldilocks era. You need to be focused on those individual opportunities. Thank you, Alberto Gallo. As ever, now, Eurozone finance ministers, well, they're meeting today in Brussels. Analysts have been turning more positive, as we've been discussing, on the European economy, with Goldman Sachs now seeing no recession in 2023. Deutsche Bank coming out with similar views as well, just in the last day or so. But still, major issues do remain for governments to tackle, particularly competitiveness compared to the US and China. Bloomberg's Maria Tadeo joins me now from Brussels with the details. Maria, what are they wrestling with on the ground today in these meetings?
Well, Tom, the bigger question is, has the mood changed? Is the zeitgeist changing for Europe? Is the worst over for the European economy? And I think that's going to be the top question in the agenda today. What is the real diagnosis of this economy? Remember, before we went into the Christmas break, this was supposed to be the winter from hell. But of course, the temperatures have really helped the European continent. And of course, the measures that they took themselves today, you see that gas prices are trading almost 80% below the peaks that we saw in August. Obviously, that has tremendous repercussions for the growth outlook, but also the inflation outlook. And that is going to be another point of debate. But beyond that, Tom, there is a topic that comes up time and again in every discussion that I have in Brussels, and that is the Inflation Reduction Act, and that is how to protect the European industry, and that is what to do with, of course, some of the sectors that could be mostly affected by the Inflation Reduction Act. Remember, there are talks that are still ongoing. The Europeans hope to get more waivers come March, but if they don't, they have to pass to a plan B, and that is state aid. But as you know, that's always a very controversial topic because it's Germany and the French that could be the biggest winners. The concern is that you turn into a two-tier economy again.
You've got to wonder when the WTO would be called in as well, along those lines. So maybe some of the clouds, economic clouds, have lifted, but those geopolitical tensions certainly have not. Maria Tadeo on the ground in Brussels for us. Thank you very much indeed. Just briefly checking in on your markets. European stocks up 0.3%. We'll keep across these market moves for you, of course. Coming up, our exclusive interview with the Qatar Investment Authority CEO. That is next. This
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Welcome to Bloomberg Markets. I'm Tom McKenzie. This week, of course, the start of the World Economic Forum in Davos, where Bloomberg's very own Francine Lacqua has been speaking exclusively to a number of executives, including, very importantly, the Qatar Investment Authority CEO, to discuss what to expect in 2023.
It's a challenging time. As you know, inflation is the main topic for the global economy. Central banks are trying to contain it. This means that they have to raise interest rate, which will slow the economies. Europe is in very difficult situation right now. U.S. will be in recession. China is just opening up, but they need to have a momentum. So definitely it's a challenging time, and the challenging time will continue on this year as well.
Connection lost.
But the good news that we have seen some numbers, which is promising that we are on the right path in terms of the containing of the inflation. And I hope by the end of this year and perhaps or next year, things will come back to normal.
Does this create opportunities for the QIA because valuations are depressed, because certain assets are cheap? So are you adding to your investments?
Absolutely. This is always, we see this as an opportunities to really reposition our portfolio somehow. We always highlight the weaknesses that we have in our portfolio, and we wait for these sort of correction in the market to fulfill the weaknesses that we have. So definitely this is a time of reposition. It's a time to fulfill a gap and weaknesses in our portfolio, and we will always continue investing.
So how are you repositioning that? I know you were very interested in technology companies. Has that changed, or are you adding to that because of depressed valuations?
Absolutely. This is not even in technology only, but Asia, U.S. market, technologies is something that we said that we need to chase our exposure on that market. So we are investing even in Europe, even in some other sectors, which is the venture capital, for example, where we are adding more exposure. Definitely, it's a time to redeploy and some investment in the right valuation.
So, what kind of companies are you looking for? Is it jewels or crown jewel like Harrods, for example, or things like that you're looking to acquire, or is it bigger companies?
Not really. I mean, we are not focusing on only trophy assets. When we go, we have a very fundamental process in terms of evaluating opportunities, and we embedded the scenarios that we see in the market. We are very connected to the market. We know what's going on, and we evaluate opportunities based on the fundamental aspect. So whether this is a trophy assets or non-trophy assets, we always deploy investment. If we find the trophy assets, that's fine. And the right valuation, definitely we will acquire it for our future generation.
We talked in Qatar about Twitter. You're one of the big investors in Twitter, and I feel like in the last 8 months, it's gone up, it's gone down. I mean, we talk about Twitter and Elon Musk every day.
Yes.
Where are we on that?
You always ask this question. And as you know, we are an investors among a consortium of investors. We are financial investors. We engage with the management, with Elon, in terms of the plan that he has for the company, and we believe on this, and we trust his leadership in terms of turning around the company. So we are into this, and we are committed to the plan that we have made to the management.
Have you asked him to tweet less in the last 8 months? There was so much volatility. Do you get involved in those calls?
Not really. I mean, we do not really involve to that extent in terms of. Again, he has our trust, and we are sure that he would manage it very professionally.
Is there another technology company that looks attractive at the moment? We've seen a lot of job losses, a lot of job cuts, a lot of cost savings. When you look at Asia, I know you can't really get involved in SoftBank, but is there something of that sort that you'd be looking at?
Absolutely. I mean, in the whole area of technologies, we are interested. I mean, digitalization is a very important theme that we are taking. So we are investing in a software application that would play a role in the digitalization. And again, Francine, we are a long-term investors.
Yes.
So we always really take a fundamental view into the sector and the theme that we are investing. Any correction in the market, it doesn't mean that we need to really play the tactic unless we would like to close a gap in our portfolio. But overall, we are a long-term investors and we take a long-term view.
What about banks? I know in the past you've been very invested in banks. It feels like it's almost a juncture because of higher interest rates for a lot of the banks.
See, financial institution is very important pillar in the mix of the portfolio that we have in different markets. So ideally, in any exposure in any particular market, we would like to have a very balanced mix on the portfolio, whether this is a technology or financial institution or real estate, infrastructure. We always aim to have this balance. So investing in a financial institution will always be a theme for us. But we're also moving to a fintech, a digital financial institution, who is becoming very popular and a very important theme in our investment.
But this would be what, something only, mobile banking online only, or a big company with a big presence online?
It could be only online banking only, or an insurance, for example. So it could be anything. This is a very important, and again, it's line up with our important theme, which is digitalization is becoming very important for the humankind.
Yeah. How much do you like football? I know there's speculation on the back of the World Cup, probably unrelated, that the QIA is also interested in buying a big stake, a sizable stake in one of the big UK football.
See, I will be too general here. I mean, football's clubs and the sport is becoming very commercialized in a way. Especially now fans are looking into this as an experience. So they would like to go and experience and entertain themselves. At the same time, digitalization is becoming very important for this. So the business model of these institutions, let's say, are becoming very commercialized and very investment friendly. So you see even funds are becoming investors in this. And sovereign wealth funds are becoming also investors in some of the club. And you will not be surprised if we invest this. But again, we go into a very fundamental process and making sure that if we invest, this is a very commercially driven for our future generation.
But would this be chosen actually on paper? I mean, we know that Man U is maybe up for sale. We know that the Spurs are looking maybe to be sold as well or have a stake. Is this a stake? Would you buy a whole club? And if there are two equal ones, how do you choose?
It's a process that we go through. It's a discussion that we engage with the management. We have not made our mind yet, but this is a very commercially driven decision that we go through.
Okay, joining us for more from Davos is, of course, Bloomberg's Francine Lacroix, of course, sat down with that interview, with the QIA CEO. Francine, braving the -8 degrees C temperature. What a fantastic interview. You covered so many different topics and angles with him. How much do you think their portfolio will actually change then? What was your sense?
Well, I think, Tom, when we talk about deploying extra capital, they talk about some of the tactically changing portfolios, which won't be very much. If you look at the long-term investment of the QIA, they haven't really held or given up huge positions in the last couple of years. But it's interesting to get the chief executive's view on, first of all, tactically, if they are looking for opportunities, which we understand that at Pains, he said, look, this is for longer-term investment. This is for the long-term investors, which is basically the sovereign wealth fund for their people. So he won't take any rash decisions. He says there are opportunities out there, and certainly he didn't deny that they were looking at football clubs.
Yeah, he did not. That was a clear line, wasn't it? He didn't push back on the idea that they're very interested. And, of course, giving his backing to Elon Musk as well. Bloomberg's Francine Lacroix, of course, on the ground at Davos, and she will bring us a string of other big-name interviews through the week. Thank you. Still ahead, a conversation with BlackRock Vice Chair Philip Hildebrand. That is also from Davos. That is next on the Fed and the rate environment. This is Bloomberg.
top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Welcome to Bloomberg Markets. I'm Tom McKenzie here in the London studio, London headquarters. We're checking on European markets, continuing to build on a record start to the year for European equities, up 0.2% on moderating views around the recession risks, and the energy story is part of that. Yes, gas prices have come off. You can see that continuing to play out today. The story currently down 11% on natural gas futures over in the Netherlands. So energy costs coming off, inflation concerns starting to ease, and the assessment from Goldman Sachs and others that maybe this Eurozone avoids a recession this year. The US, of course, closed for a national holiday. Futures, though, pointing lower by 0.3% after a pretty decent week last week across Wall Street and US equities. The Japanese yen is in focus for us this week and today. Weakness today, down 0.4% versus the US dollar, trading at 128. The context is that the Japanese currency is near the highest levels since about May of last year, and we're looking ahead to the BOJ meeting on Wednesday. Speculation that maybe they step back from their ultra-easing monetary policy. That's a check on your markets. Let's get you up to speed with some of the other stories from around the world and bring in our first word and Angel Feliciano. Angel.
Tom, in the UK, teachers may join hundreds of thousands of employees who have gone on strike for higher pay. The National Education Union will announce the results of a strike vote today. Meanwhile, the House of Commons will debate anti-strike legislation. In Germany, Defense Minister Christine Lambrecht has stepped down after a series of missteps and days of speculation about her future. It is a blow to Chancellor Olaf Scholz's government. Lambrecht's departure comes as Berlin is debating whether to supply Ukraine with tanks to fight Russia. In China, the government announced that almost 60,000 people had died of COVID in the last month. That's led to calls for authorities to provide more data about the wave of infections that is sweeping the country. The virus has been spreading at a faster pace since Beijing abandoned its COVID zero policy. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Angel Feliciano. This is Bloomberg. Tom.
Angel, thank you very much indeed. Now, Bloomberg TV is live, of course, at the World Economic Forum in Davos, Switzerland, throughout the week. And earlier today, Bloomberg's Francine Lacroix spoke with Philip Hildebrand, BlackRock's vice chairman, and asked for his take on the inflation outlook.
I think people are still shaped by a very difficult year. So I think there might be a risk that we get into a kind of excessive pessimism, judging by what we've all been through. There are lots of reasons to be worried, but I think there are also many opportunities. So we'll see how it settles in.
So do you think inflation has peaked?
Oh, very much so. I think inflation is going to drop very, very quickly. In fact, I believe many of us will be surprised how quickly it will fall. The problem is it will fall very quickly. Sort of 9 to 4 will be the easy part, and then it's going to get very difficult to get inflation back to price stability. So, but at the moment, I think the initial phase will be a very rapid decline in inflation.
So what does it mean for central banks, Philip? And you lay this out beautifully, actually, in your World Outlook. If you're a central bank, if you're like the ECB, or even if you're the Fed, do you have to be much more careful in how you manage this from now until the summer?
I think the central banks are going to continue on their tightening path. They're going to be very careful, very focused on not losing the long-term inflation expectation anchor. And so I think we're going to see, you know, I don't see any chances, frankly, of easing this year. I think the market has that wrong. So they're going to make sure that we can really not just get from 9 to 4, but also limit any kind of risks that inflation expectations become unanchored. And because all of this is driven by labor market constraints, principally, it's still a supply side story. It's going to be very difficult to get inflation kind of below 4%, let alone below 3%. So we're in the easy phase, in a sense, now of this tightening cycle.
But is there a problem with that markets don't understand that? So we have, for example, Fed officials saying, look, don't expect a Fed pivot anytime soon, but the markets keep on testing it.
That's right, and you know, I think this notion that there could be easing this year seems to be, to me, to be far too optimistic, because if you're the central bank, you're going to want to make sure that you can get this done, that you don't risk resurging suddenly of inflation expectations further down the road. So I think we're going to see at best some sort of pause, but not quite yet. And the market may need some readjusting relative to these expectations that we could be seeing some easing. And this is what we call it's a new regime. The great moderation is over. You know, this notion that when the economy struggles, central banks will ease, that was true in the past. I don't think it's going to be true this time.
And yet it's quite incredible to see actually the leverage being taken, or for companies that are leveraged, and interest rates going from 0 or 1% to where we are now without more bankruptcies. Are you expecting zombie companies to crop up?
I think it all depends how much damage will have to be inflicted on the real economy to get this last phase of the inflation being squeezed out from, let's say, 4 back to 2%. And you know, that will be the big trade-off. So this will not come without cost. I do suspect at some point the central banks will kind of back off. And not drive inflation all the way back to 2%. That might be a moment when the market can recalibrate. But for now, I see the tightening process continuing to ensure that we don't just go from 9 to 4, but can actually continue to bring inflation back under control.
So when's crunch time? I mean, if we try to put inflation 4 to 2%, does that coincide with the beginning of the summer months, or could it be later into the year?
I think we're going to see very quickly kind of dropping to 4. That's going to be, in a sense, the easy part. And then the question will become second half of the year, mid-year, what do the central banks do at that point? Do they continue and tighten far beyond what is currently expected in order to drive inflation back to 2%? I think that would entail pretty significant recessionary tendencies in the real economy, a lot of damage to the real economy. Or do they at that point say, okay, we've done enough, so let's see what happens if we let inflation persist for a bit above the 2% target?
So what does this mean for markets overall?
Well, yeah,
volatility or pain?
So there will be opportunities, you know, not least in credit, in short-term bonds. We now have a very different outlook again when you look at where interest rates are. So for long-term investors, many opportunities, I think, in that space. For equities, I suspect until we know what the central banks are going to do with that residual piece of the inflation adjustment from, let's say, 4 to back to 2%, there are going to be some challenges around equity markets. You know, so some of the enthusiasm right now with this notion that the central banks could ease again imminently, I suspect that's premature. So I still see some volatility here going forward until we know how the central banks are going to handle this difficult trade-off that they face.
But in November and maybe early December, the talk was all about the lack of liquidity in the markets and what that could do in terms of schisms or things going wrong. We don't really talk about that anymore.
Yeah, the markets have, you know, if you think about what's happened in the kind of Bitcoin space, in many other areas, the market has actually adjusted reasonably well. The banking system seems to be in pretty good shape structurally relative to 2008. We don't see the excessive leverage in the system. So I think there is, you know, it's one of the positive aspects of the story here that we haven't seen kind of major disruption in the financial markets as a result of these tremendous adjustments. I mean, 2022 has been a year of amazing transition and adjustment.
But could it just be delayed?
It could be. I think, again, it depends very much on how damaging the recessions are going to be, which, again, in turn will be a function of how aggressive will the central banks ultimately be to get inflation back to 2%.
There's the COVID component, I guess, right? There's a lockdown component. Does that change consumer behavior? Because when we say inflation has peaked, but also consumer behavior has stayed strong, could we be looking at a distorted reality?
I think what we're going to see, this is one of the reasons I believe we're going to have, certainly in Europe, a mild recession, probably quite likely in the US as well. The savings that have been accumulated and generated as a result of COVID, they're going to run off by the mid-year, by the summer. That's going to be exactly the time when the tightening that we've seen, this has been the most aggressive tightening cycle in history, basically, when that starts to kind of bite in the real economy. So that's going to be a difficult moment mid-year when you have the savings effect fading, and at the same time, the rate cycle, the increases in interest rates kind of feeding through the real economy.
Who has the most difficult job right now? If you look at the ECB, the Bank of England, and we talk about the UK, but also the Fed and the Bank of Japan.
I think probably the Bank of England, because it has, in a sense, the worst of both worlds. It has the labor market supply-side constraints that we see elsewhere, and it also has the energy shock. So in a sense, Europe has mostly the energy shock. The U.S. has mostly the supply side, the labor market constraints that are leading to these wage pressures and tightness in the labor market. The Bank of England really is hit with both challenges at the same time. And you can see this in the fact that they've had to do the most. And the trade-off, the cost of bringing inflation back under control will be the highest, in a sense, in the UK as a result of this constellation of being hit by both of these forces at the same time.
So is there anything that they can do to calibrate it? Because the Bank of England governor is also having a pretty tough time, I have to say, from all sides, about being too slow, being too aggressive with interest rate hikes. Like, how does he do?
Well, I think you have to be honest about it, and that's, this is the new world. In the old world, the great moderation, you could get inflation under control and everything else would be fine. Now, bringing inflation back under control means you have to damage the real economy. It means you cause a recession.
Yeah.
And there's no way around this. This is why we are in a new regime, why investing has become more difficult. It's much more complicated, and I think the best thing the central banks can do, and more or less they all do this now, is to be open and acknowledge that bringing inflation back under control, bringing price stability back into the game, entails essentially recessions. So think about it in this way. In the past, central banks always came to the rescue to get you out of a recession. And now we have exactly the opposite. The central banks have to, in a sense, engineer recessions, or at least contracting economies, in order to get inflation back under control.
How do you see China opening, or opening with I guess great difficulty? We know we have also the vice president of China here, so there's only one G7 prime minister or president, and that's the German chancellor. But we do have the vice president of China.
I think this week is important here because, remember, nobody has been to China in several years. There's been very limited interaction, even by telephone, by video. So to actually meet the Chinese leadership, the economic leadership at least here, will be a very important part of the financial industry, the corporate sector. From what we know from our office in China and elsewhere, the opening is happening in a very aggressive way.
Yeah.
I think that should lead to more easing of the supply side constraints. So when I talked earlier about the rapid decline in inflation, that's certainly going to contribute to it. So there are definitely elements of very good news in terms of bringing inflation rapidly down from these very high levels at this point. And China, I think the reopening of China is a big part of it. How the COVID, the health dimension of this works out, I think is very difficult to judge from afar.
Are you expecting a lot more, a lot less regulation? What's your one question to the vice president when you meet him?
I think the main question today will be, where are they on the calibration between control and markets, in a sense, right? And we've seen an extreme move towards control. And the question is, are we seeing some recalibration in order to get growth, in order to reopen, in order to help address the world supply chain problems?
And that was BlackRock Vice Chairman Philip Hildebrand with Bloomberg's Francine Lacqua speaking earlier today, of course, at the World Economic Forum in Davos, Switzerland, ending on the question of China and the calibration between control and the markets. And the markets over in China, the session was positive today, CSI 300 ending up 1.5%. And that has fed into what we're seeing in Europe. And the optimism around European equities continues. We're seeing modest gains of 0.2%, but within, again, the context that year to date you've had a record rally, gains of a little over 6.5%, and the positioning suggests there is more upside to be had for these European markets. Futures in the US currently pointing lower by 0.3%. Of course, US markets closed for Martin Luther King Jr. Day. The yen is in focus, 128. That's a little bit softer, down 0.5%. The BOJ making their decision on Wednesday. European gas futures, and this plays in to the optimism around potential for Europe to avoid that recession as inflation comes off, and European gas prices are a central component in with that. They are falling again today, down, as you can see, 12%. So that is the state of the markets about 4.5 hours into the European trading day. Coming up, we're going to have a fresh dose of optimism, at least that is the view again, on those European gas prices dropping to what is now a 16-month low, easing those recession fears and concerns over China's reopening. We're going to get more details, more context on that conversation. Of course, the likes of Goldman Sachs now suggesting that the Eurozone will avoid recession. Stay with us. This is Bloomberg.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Welcome to Bloomberg Markets. Let's get to what is happening within the energy space. The much anticipated cold winter failing to materialize in Europe, with mild temperatures driving gas prices down to a 16-month low. But the region is not in the clear yet. That is the view from Iberdrola's Ignacio Galán, the executive chairman of Spain's largest utility company, saying, quote, "As long as energy markets are over-reliant on fossil fuels and exposed to geopolitical events, they will remain fragile. We should not think that the energy crisis is over for good." For more, let's bring in Bloomberg's Rachel Morrison, who joins us from Davos. Rachel, hopefully staying warm. Give us the context around what we're seeing in the gas markets, the European gas markets. Today, a further move lower of 12%, and maybe the role that China is starting to play with its inventories around LNG.
Yes, really, we've seen a big sell-off in gas prices, and that's been around mild weather, Europe using a lot less gas than we thought we would by this point in the winter, which means that storage levels are still pretty full, and we're starting to see more and more optimistic estimates for how much storage we might have left by the end of the winter, which of course makes it easier to refill next winter. So that's kind of adding to this very bearish atmosphere, which is obviously positive in terms of the crisis. And what we're trying to weigh up is whether the crisis is over, whether there could still be a shock. You mentioned China. Everybody's been looking to see if and when demand from China will rebound. It hasn't happened yet. We still can't fully rule it out, but those are the factors that people are looking at. And you know, as Iberdrola chairman Ignacio Galán said, he wouldn't put money on it being completely over for now. We can't relax, but we are hearing the message from some policymakers around Europe that, you know, Europe is okay this winter for sure, next winter's looking good, but you know, some people in the market have a slightly different view to that.
Yeah, it's really interesting, and of course we don't want to take too much relief from what we're seeing in terms of the prices coming off, but it ties in, of course, into economists' assessments of whether or not the Eurozone ends up in recession this year. You flagged a few of these, Rachel, but just drill down on what some of the key factors you're looking for in kind of the weeks and months ahead to give us a bit more clarity on where gas pricing goes from here.
Well, one of the things that we know is that there isn't going to be any change really in how much gas there is overall in the market until about 2026. So what that means is that it really depends on demand and how that plays out, whether it's people actively using less gas, trying to save energy, or whether that comes from mild weather and, you know, people just feel the need to have less heating on. So both of those factors are, you know, really important. And also when it comes to LNG cargoes, where those are going, we know that there is actually a premium at the moment to Asia, but cargoes are still coming to Europe. And that's mainly because if you have a cargo to sell, you've got more chance of selling it in Europe at the moment because of that element of uncertainty. We don't know what prices will do. There could be an event that means that prices spike again. And also with energy, with, you know, huge amounts of combustible, flammable liquids and gases, there are accidents, there are fires. At the Friday evening, we saw an event. Things like that happen and seem to be happening more frequently. So those do add an element of risk that perhaps, you know, we're not just on a downward track for the rest of the winter.
Okay, really, really great context as ever. Rachel Morrison, stay warm, trying to stay warm in Davos. Thank you very much for the update on the gas situation in Europe. Sticking with energy, let's bring in Mizuho's Anthony Crowdwell now for more context and maybe how to position what you like, what you don't like. Anthony, good morning. Thank you for joining us. Give us a sense of, there was the outperformance, of course. We'll go to utilities and the outperformance of utilities last year and your views as to whether or not that outperformance can continue into and through 2023.
Yeah, good morning. It's going to be hard. We had a great 2022. We outperformed the S&P by 17, 18%. If you think about as we went into 2022, you know, we started seeing interest rates rise, but our sector, utility sector, kept grinding through it. We think it's going to be unlikely you see that into 2023. And I think the couple big pushbacks, one is rates doubled, interest rates doubled in 2022, and our sector typically does trade on a bond proxy, and we did not come in at all. Our stock prices stayed robust all year, 18% outperformance. So we think that's going to catch up to us. On a historical basis, we typically trade at about 75% of a bond index, a Moody's BBB bond index. And right now we're only about at 50%. So definitely stock prices need to come down to get us back to that 16, 17-year average. Second, just right out there, it's been a long time since we had back-to-back years of outperformance. In the 2004 to 2009 period, we did have some back-to-back outperformance. But that was when the sector was less of a pure play, more of a commodity-driven story. And a lot of the stocks at that time, the utility stocks, had non-regulated business that were relying on natural gas prices. It's funny, we just followed that. And natural gas price at that time, if you remember, ripped with fracking and all the shale plays. Now that we look at a pure play, we have not outperformed back-to-back since 1990. So we think 2023 will not be a year of outperformance. We're more cautious on the space and are recommending investors go with the quality names to protect themselves the best.
And how much of that is also down to the fact that the valuations are now not looking as attractive as well? After that, 17% outperformance for the sector in 2022? What is the state of valuations at this point?
Yes, the state evaluations, they are rich, especially on a yield basis, right? When we look at a yield basis, as I said, we typically trade at 75% of a bond index. Right now, we're at 50% on a PE basis. Yeah. I think we're more in line when you think we'd be trading at a discount to the S&P. But we're concerned with it. Everyone's predicting either a short, narrow recession or, everything that's short in duration or not that deep, I think is going to really impact us. And you'll see investors transition more to growth stories. And our stocks are going to look very rich. Earnings growth is still intact. We're still guiding to roughly about 6% earnings growth. Average yield is about 3%. So you're kind of getting 8 to 10%, or let's call it 9%, total return when you add the yield and earnings growth. It's just that, as you brought up, valuations are stressed, especially on a yield basis, and we're going in a more cautious approach to 2023.
And when you drill down, where are you finding that earnings resilience?
If you think about how the model works in the U.S. for U.S. utilities, it's typically they earn off of net plant, or we use the term rate base. And so if you think of rate base times an equity ratio times a return on equity that a regulator sets, when you multiply those three items, you get what our permitted earnings are. That's the utility sector. So to really grow earnings, you need to grow rate base. And that's just the investment in the wires, pipes, infrastructure that you see utilities making. And so far, regulators have not stopped, allowing utilities to, reinvest in the grid, renewables, the energy transition story. They are looking more closely at it. They're getting more scrutiny with inflation headwinds. But that growth story is still there. And they're spending record levels of capital to reinforce the grid stability. You've seen the storms hit here. Florida had some storms late in the fourth quarter or mid-fourth quarter, and yet the utilities there did a great job of restoring customers. So that spending is still in place, and so I continue to look for that, to continue to look for earnings to continue to grow. Where that could change, though, is if you see regulators start tapping the brakes on these robust capital plans. We have not seen that yet. We've seen just more scrutiny with, maybe depreciation rates and everything on the margin. So far, these capital plans are still intact.
How does the Inflation Reduction Act fold into the utility space? How much of that is priced in, that activity over the longer term?
The Inflation Reduction Act was tremendous, especially for the names that want to go renewables or had some unregulated nuclear generation. I guess the name that benefited the most was Constellation Energy, ticker CEG. That just created a floor of earnings for their nuclear plants. They own a fleet of unregulated nuclear plants. IRA comes in and it really reprices that equity. Also, names like NextEra Energy, ticker NEE. They're, a huge fleet of renewables. That adds, tax breaks, tax incentives to these guys. It extends it, provides more clarity, and so that's helping out. And lastly, for the regulated guys, for your typical utility in your town that's looking to invest in renewables, it allows them to transfer their tax credits, which is something new that regulated utilities could not do. So I think that's going to make them more attractive to keep going with the transition story. So the IRA kind of helped out the whole sector, but the biggest beneficiary, I thought, was Constellation with their unregulated nuclear plants, and that just provided a floor of earnings for their output.
Okay, Anthony Crowder, really, really interesting insights into the utility space with a particular focus on what is happening in the US and the overlay of that Inflation Reduction Act and maybe the regulatory risks that could raise their heads later this year. Anthony, thank you very much indeed, of Mizuho, of course. Let's check in on these markets then, again, about 4 hours, a little under 5 hours into the European trading session. You're still seeing gains of around 0.3% across European equities. Futures in the US, the S&P is pointing lower by 0.2%, Nasdaq futures lower by 0.3%, when of course those markets do reopen tomorrow after the national holiday. Here in the UK, you're seeing gains of about 10 points. And in your currency space, the Bloomberg Dollar Index just up 0.1%. Coming up, we're looking ahead to the Bank of Japan's policy meeting. That is still ahead. Stay with us. This is Bloomberg.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, we have a unique way that we look at big new investments. And I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do, and any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs, and the ultimate output for a company is share price, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight, with replays all weekend on Bloomberg Television and Radio.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Welcome to Bloomberg Markets. I'm Tom McKenzie, checking your markets 5 hours into the European trading session. Of course, is a holiday, national holiday in the US. You're seeing gains still across European equities this Monday, 0.3% building on a record start to the year. Gains of more than 6.5% across this benchmark on expectations. Hopes that maybe inflation is starting to turn, that maybe the Eurozone will avoid a recession. Futures in the US pointing lower by 0.2% for when those markets do reopen. The context is, of course, that Friday you ended up, the highest levels in about a month on US equities. The Japanese yen is in focus for us today. We're going to unpack this story for you in the next couple of minutes, but it's pointing lower by 0.4% today, 128 on Japanese yen. Of course, in focus, the BOJ and that decision on Wednesday, the importance of whether or not they adjust their ultra-loose monetary policy. And gas prices, these are the gas futures, Dutch gas futures in Europe, further losses, down close to 13%, 16 straight months, it's a 16-month low now, these gas prices, and that is tying into the view that maybe inflation is starting to edge off for Europe, and maybe, possibly, the Eurozone, as Goldman Sachs predicts, avoids that recession, tying into the equity market moves as well. Right, let's get you up to speed with some of the news from around the world, and our first word with Angel Feliciano. Angel.
Tom, in Italy, the mafia's most wanted boss has been caught after 30 years on the run. Italian military police arrested Matteo Messina Denaro at a private clinic in Palermo. Messina Denaro has been convicted for dozens of murders, including those of 2 judges. The UK and the European Union are close to a deal on post-Brexit trading arrangements in Northern Ireland. They are nearing an agreement on customs. That's designed to reduce frictions between Great Britain and Northern Ireland since the UK left the bloc. U.S. Treasury Secretary Janet Yellen will hold her first face-to-face meeting with Chinese Vice Premier Liu He tomorrow. They will meet in Zurich. The surprise announcement follows the November meeting between President Biden and President Xi Jinping. That led to a modest thawing of relations between the 2 governments. And Italian-born film star Gina Lollobrigida has died. She was one of Hollywood's most sought-after actresses in the 50s and 60s and shared the screen with leading men such as Humphrey Bogart, Burt Lancaster, and Frank Sinatra. She was 95. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Angel Feliciano. This is Bloomberg. Tom.
Angel, thank you very much indeed. Now, European stocks kicking off the year with the biggest first 2-week advance on record. As I mentioned, that continues today, further upside of a little under 0.3%. China's reopening and declining energy prices fueling outperformance over the US. Wealthwise Financial CEO Laureen Gilbert weighing in, writing, quote, "The euro has strengthened considerably against the dollar since September. We believe this has been and will continue to be constructive for European equities in 2023. Very pleased to say Laureen joins us now. Laureen, before we get to the earnings picture then, as I flagged in the break, let's get that view. Let's unpack that view then. The outperformance of European equities will continue versus the US. Just unpack that view for us, what you're seeing in terms of the catalysts for this European market.
Sure. Well, with Europe, they were struggling quite a bit. I mean, the war with Ukraine put a damper. Now there's more tailwinds there with the dollar weakening, the euro strengthening. That's going to be a tailwind going forward. And as well, just looking at this winter hasn't been the devastated winter that many were expecting as far as what is going on with gas prices. So with all of that, we see that Europe is rebounding and most likely much stronger than the United States. So we've increased our weighting to international securities, including Europe, starting to look at Asia Pacific as well, and all of emerging markets. So our call is on all of the international equities.
Okay, and how defensive do you want to be or not within the European equity space? Is it a value play? Is it cyclicals? How are you positioning within that space?
Yeah, overall, we do like value over growth, just being a slow growth environment right now and slowing down. So with that, we still think, we said last year was going to be more of a value play, and it was. And then this year as well, we think value across the board, across international and domestically in the United States. Value is our call.
What is the China catalyst? How do you want to play the China reopening theme, and how much further do you think it has to run?
Yeah, so one of the things that we're doing is waiting to make sure that the reopening is real. It certainly seems like it is, and if it is, that's going to do well with the consumers there in China being able to spend, being out and about, being able to purchase goods, et cetera. So with all of that, as we continue to watch, we think that that is the catalyst that will drive things forward as they start to grow their economy again.
Laureen, what was your assessment of the bank earnings that we got through from the US on Friday? It seemed to be a bit of a muddied picture, and you flagged for us that you think that maybe loan loss provisions are overly conservative, the likes of JP Morgan and Citi. Was that one of the key standouts for you? What does that tell us about the defensiveness, or at least the caution within those banks?
Sure. Well, we always look to the bank earnings as that first sign of what's going on with earnings in that last quarter. And they did come out quite strong and beat expectations. So that's the overall theme, that they did beat expectations. However, like you mentioned, keeping those loan loss reserves high, what that tells us is that in future quarters, they're probably going to let that go, and all of that will fall to the bottom line. So the areas that did well so far are those companies like JPM, which are interest rate sensitive and have benefited from rising rate environment. And then what we're looking to in the following quarters is as those companies release those loss reserves, then that will go to the bottom line. So far, so good overall. And then, we're going to hear from Goldman. We'll see. We're not expecting as stellar results there as we saw from some of the other bank earnings.
Do you need investment banking to come back with force to have real conviction around the banking space?
Well, the banking space is diversified. And certainly with interest rates on the rise, that's helped them. But as far as the business cycle is concerned, certainly we want to see the investment banking happening. And we think that will start happening again in 2023.
The all-important housing market, and I know this is a focus for you as well, in the US after the cooling off that we got last year, not just the US, of course, places like the UK, Australia, Canada as well. What does the picture look like for the housing market, and how do you tie that into your equity calls for 2023?
There's no way to ignore the fact that rates are twice as high as they were a year ago. So that has impeded and is going to continue to dampen housing prices and sales. However, there are many areas where sales are still strong just based on supply and demand. And so because there are not enough houses, that demand is still going to be there. The problem is it's just not affordable. And so whenever we see housing prices not be affordable, there's a rollover in price. So we do think that housing prices are on the way down, and for people to be very cognizant of that, because interest rates are high, housing prices are coming down. So for a lot of people, they're just waiting to buy, waiting to sell. So there's this slowness in the market, so much so that Wells Fargo has pulled out of mortgages for now. And so I think we're going to continue to see that kind of behavior by companies as they're looking to see that it's a difficult environment in the home mortgage space.
Lauren, how does consumer discretionary play? How vulnerable is that sector within this environment?
Well, consumer discretionary is very vulnerable because as the economy slows, and we know it's slowing, we don't know how much it's going to slow, but most of us think that we're going into some kind of recession, maybe not a severe recession, but a recession nonetheless. And so with that, anything to do with the consumer is going to be soft. So that's an area that we are steering away from for now. I do not think it's going to be, it's certainly not going to be one of the biggest sectors this year.
Okay, Lauren Gilbert, CEO of Wealthwise Financial, thank you very much indeed joining us this Monday morning out of the US on that call for exposure, at least outperformance, continued outperformance of international equities versus US equities. Now shifting to central banks and the Bank of Japan, as I mentioned, that decision is on Wednesday. Investors remaining on high alert for any further policy tweaks, with December's shock decision failing to significantly improve market liquidity. Joining us now for the deep dive on the BOJ and the implications for the broader funding market and fixed income is Bloomberg's Ven Ram. Ven, fantastic to have you in the studio to break this down for us. Just flag for us why it is so important, why we should care about the BOJ decision this week, and what you think the likelihood is that they actually walk back from yield curve control.
Well, I think to answer your second question first, I don't think they're going to, they are going to have to cede control on the yield curve sooner or later. We think that that's going to come later rather than sooner, i.e. not this week. I think it's important in the context of what's happening in Japan because it'll mean the end of Kuroda's regime where he was super accommodative in terms of the monetary policy, and with the rest of the world moving away and shifting away on yield curves and interest rates and what have you, the Bank of Japan has no choice but to move with the rest of the pack.
And I was speaking to an economist at a hedge fund over the weekend. He said, look, it's an easy trade. You short JGBs, even if you don't think they're going to give up this week, in the next few weeks. It's an obvious trade that yields are going higher. What does it mean in terms of fund flows then, if Japan, and when that point comes? You don't think it happens this week. You think it happens, though, at some point, relatively close to this time frame. What does it do for fund flows internationally?
I think that there's going to be a big shift in fund flows, particularly away from probably Japanese equities, because what we saw last year in terms of Japanese equities benefiting from low rates is not going to be as easy a trade. And I think that, you know, in terms of the yen, I think the yen is going to be a big beneficiary of the BOJ walking away from curve control. though I think it's a story for the spring. Of course, in the past 10 days, fortnight alone, we have seen the yen do a big three-figure rally. I don't think in the short term it's sustainable.
Is there a level you're watching for yen? It's 128 today. Is there a level?
I think it could easily correct to 130, 131 if the BOJ refuses to cede control on the curve this week.
Does the BOJ get any relief if the Fed steps down to 25 basis points at the next meeting?
Well, we need to see how inflation in the US evolves over the longer term. I do think that the Fed has very little incentive to stop before it gets to 525. 17 out of 19 participants have already flagged 5.125 is the rate they want it to be, the Fed funds rate to be. So I think that we won't get any respite to 525, whether we get it in 25 basis points or 50 basis point increments is I think is the smaller part of the story. The big picture is that the Fed will keep going, and I don't think there is a pivot coming as the market expects. I think the markets are getting that wrong.
And if, as you expect, the BOJ does not abandon this policy this week, it's inevitable, is it, that they step into the markets again and continue buying?
Yes, they will have to continue buying, albeit I think it'll tamp down a bit. I think the next meeting is on March 10th. I think that, again, the vultures will start swirling. But I think that, there's a very high chance that the Bank of Japan may actually cede control of the curve at a non-scheduled policy meeting rather than do it at a policy meeting, just like the S&P torpedoed the markets in 2015.
Okay, the vultures are circling. It's not going to be this week. That's the call from Ven Ram. And, of course, Kuroda stepping down in April of this year. Ven Ram, excellent analysis as ever. Thank you very much indeed. Just checking in on these markets. Let's start with the Japanese yen then. Currently trading at 128, so down 0.5%, but still, of course, the rally has been there. It's still at levels close to the highs of May of last year. Across the benchmark here in Europe, gains of 0.3%. Futures in the US pointing lower by 0.2%. And those European natural gas futures continue their march lower, down 13%. Again, tying into the optimism, modest optimism, that maybe inflation has peaked in the Eurozone. European markets as well, the technicals not looking overbought at this point, giving the view that maybe there's further upside for those European equities. Certainly that was the view of our previous guest. The outperformance will continue this year. Stay with us. This is Bloomberg.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Happy Monday. Welcome back to Bloomberg Markets. I'm Tom McKenzie. US markets, of course, closed for Martin Luther King Day, national holiday stateside. The futures in the US pointing lower on the S&P E-minis by around 0.2%. NASDAQ futures down by 0.3%. Not taking much respite, these US futures, from what is a pretty decent session here in Europe. Halfway through the day, gains of 0.3%, building on the record start to the year for European equities. And again, the technicals suggest there is further upside for European stocks. Recession concerns starting to ease, at least on the fringes. And inflation, question marks as to whether or not that has indeed peaked. That ties into the energy story. Natural gas futures moving lower again today, down 12.5%, as the inventories in China suggest that maybe some LNG shipments will move from Asia to the European space, helping to further ease the constraints around energy. It has also been, of course, a milder winter, and Germany has managed to get up to 90% in terms of its gas inventories. Futures in the US, as I mentioned, down 0.2%. The Japanese yen, 128. So weakness coming through for the Japanese yen, but the story over the last few weeks, of course, has been strength for the Japanese currency. It's currently down 0.5%. M9's Ben Ram telling us he does not think that the BOJ will abandon its yield curve control policy. It's ultra-loose monetary policy this Wednesday at their meeting. Others, though, take a different stance, including Citibank, who think that they will. So that debate continues, and of course consequential for the yield curve in Japan, and of course that currency, 128 on the Japanese yen. Let's get, though, to the fiscal policy and the politics of the United States. US Treasury Secretary Janet Yellen raised a warning flag last week, saying that the Treasury will begin taking special accounting maneuvers from this Thursday, to avoid breaching the US debt limit. Terry Haynes, Pangaea Policy founder, joins us to give the context, the details, the implications for these markets as well, Terry, and whether or not markets are being overly relaxed about the potential fallout with this debt ceiling. Terry, good morning. Thank you for joining us. The importance then of what we heard from the Treasury Secretary, taking special measures, is it unusual? What does it tell us about the depth of concern within Treasury?
Tom, good morning. It is not unusual for the Treasury Secretary to engage in these extraordinary measures. It is the beginning of a run-up to frankly dealing with the possibility of default by summertime. In this case, most projections say. What's different this time? What's different for the first time in a decade, I think, is that some elements in the Republican Party are really pushing the idea that what they need to do is have a debt ceiling raise and combine that with some sort of fiscal discipline, either slightly lower spending, potentially something else. So this is a real political problem that is rapidly going to turn into a real market overhang fairly soon. I've been banging on for a while that I think the default risk goes up to as much as 40% by summertime, and I'll stick to that today.
And that's a pretty bold call, 40% in terms of the default risk this summer, and the market's clearly not pricing that in. So there is market complacency around this risk, Terry.
Well, I think there's the markets react to this sort of stuff as, the guy on TV just told me that something's going to happen in June. Well, great. I've got 5 or 6 months. So there's that. But this is going to be an increasing overhang as the political rhetoric escalates and people start figuring out that this is not a bluff that's going to get easily resolved. Markets have been inured over the past decade to Washington drama and things that mean a lot politically but don't mean a lot in market terms. And they'll be slow to recognize that this time is a little different, I think.
Ultimately, it's going to come down to the numbers. It's going to come down to getting lawmakers to put their votes behind this. What is the ability for the Democrats, for Biden to rally the Democrats? The Democrats, is Biden willing to make any concessions on this issue? And can McCarthy rein in the quote-unquote extremists on the right of his party?
Well, it'll shock you to learn that both sides are politicizing this to some extent. On the one hand, Republicans want to use whatever leverage they can. On the other side, the president says that he's not going to negotiate at all on the debt limit. So in the end, there's going to have to be some accommodation. My default risk is only 40% by summer, frankly, because the way I look at Washington, there aren't two political parties. There are 4 factions. There are progressive Democrats, centrist Republicans, conservative Republicans. 3 out of the 4 of those, with the exception of the true conservative Republicans, are going to want to put a solution into place that makes sure that default doesn't happen. So, I remain relatively bullish, even though the call is that the risk will be very high. But this is going to take an awful lot of brinksmanship. There is no incentive for any of these people to back down anytime soon. So I wouldn't look for a solution here anytime soon. Thus one of the reasons why I think the default risk is so high.
What is the role of former President Trump now? The leverage that he has over this Republican Party as they position themselves for the next set of elections, 2024, of course. Is Trump still the force that he once was?
Not at all. I'm waning by the day, I think. I've started writing and updating because it's the gift that keeps on giving. That I think Trump has jumped the shark politically. It's an old entertainment world idea when you're calling attention to yourself in a desperate attempt to keep your ratings up. He's been jumping the shark again and again and again, with a variety of antics. But the thing that was really beyond the pale was right after the election when he suggested that suspension of the Constitution might be in order to get him what he wants. You combine that sort of lack of understanding or reverence for constitutional checks and balances with the political fact that the loser, having lost in 2020, having lost effectively the midterms, in each bring what you saw, you would think
Okay, Terry. Unfortunately, we're having some technical issues, and it's a real shame. It happens sometimes on live TV, but we've got some really important points there from Terry Haynes in terms of the political risks of this debt ceiling and the 40% chance of a default. Again, to stress that Terry Haynes does not believe ultimately that will happen, but the brinkmanship, he says, will be acute. And they're just lastly ending on his views as to the waning influence of former President Trump on that Republican Party. Terry Haynes, thank you very much indeed, and apologizing to our viewers for those technical issues. Let's check in on the markets. You are seeing gains of 0.3% across European equities. Now take a look at sectors as well, because top of your list is real estate, currently gaining 1.6%. Financial sector is also gaining 0.8%. And when it comes to the financial sector, of course, we continue to unpack the earnings from the US banking sector. We have Goldman Sachs reporting tomorrow. European banks don't report until the end of the month, and of course they will give us a gauge as well in terms of loan loss provisions as to how concerned those banks are about a potential recession in the Eurozone as those calls come through, adjusting the views on as to whether or not, in fact, a recession comes through. Goldman Sachs thinks that the Eurozone will just about avoid a recession. And as I've been mentioning, part of that call is tied to what's happening in the energy space. And again, you're seeing some fairly positive momentum in terms of softer gas prices again, which will underscore that view, or at least give some ballast to the view that inflation will have started to peak here in the Eurozone, and maybe that recession will be averted because the energy crisis is becoming less acute. There's a number of caveats to that, of course, as our team have been pointing out, but that is the picture as it stands. The Japanese yen currently at 128 versus the US dollar. That's down by 0.5%. And the Bank of Japan, that speculation, the market's really taking a pot shot at the BOJ to see whether they will blink on yield curve control after that surprise decision to increase the cap from 0.5 to 0.5 in the month of December. Of course, some speculating that maybe they'll abandon that policy altogether as soon as this week. That is not the view of our Venram from MLive. Just across your currency space, you're seeing the Bloomberg Dollar Index gaining 0.2%, the Euro at 108, and Sterling at 121. Still ahead, we head back to Davos for a conversation with the Saudi Arabian economy and planning minister. Stay tuned for that interview and the context. This is Bloomberg.
seeds, typically between the time you start and they get out in the farmers' fields is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Welcome to Bloomberg Markets. I'm Tom McKenzie. The rally continues across European equities, gains of 0.3%. A little bit more caution, though, seeping into the future stateside, pointing lower by 0.2% on Martin Luther King Day. Of course, markets closed for that national holiday. The yen under pressure, down by 0.5%. But the gas story in Europe continues to evolve in a positive direction. Prices down 12%. Let's get you more from around the world with the First Word News and Angel Feliciano. Angel.
Thanks, Tom. In the UK, teachers may join hundreds of thousands of employees who have gone on strike for higher pay. The National Education Union will announce the results of a strike vote today. Meanwhile, the House of Commons will debate anti-strike legislation. In Germany, Defense Minister Christine Lambrecht has stepped down after a series of missteps and days of speculation about her future. It is a blow to Chancellor Olaf Scholz's government. Lambrecht's departure comes as Berlin is debating whether to supply Ukraine with tanks to fight Russia. And more problems for President Joe Biden in the investigation of classified material. Additional documents have been found at his house in Delaware. Now the Republican chair of the House Oversight Committee, James Corner, wants the White House to release visitor logs from the home. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Angel Feliciano. This is Bloomberg. Tom.
Angel, here in London, thank you very much indeed. Let's get back out to Davos, where Bloomberg's Manus Cranny has been speaking with Saudi Arabia Economy and Planning Minister about growth in the Saudi Kingdom.
Saudi Arabia is today, without a doubt, the global growth story. And when we look beyond the actual GDP numbers, we're expecting 8.5 for the last year, 3.1. The World Bank is expecting 3.7% GDP growth. What we care about is actually our non-oil GDP growth, our non-oil activities, and how much we detach from oil. So we're steadfast in our transformation. We have the fiscal discipline. We have the economic transformation tools, and we're moving forward with them.
And those are very worthy headlines, but with interest rates careering towards 5%, we've got Larry Summers telling us, get ready for a tumultuous year. Are you ready for a volatile year? Can it be a year of two halves almost?
Well, we know that the banks, especially in the U.S. and the ECB, they're trying to increase interest rates in order to control a bit the inflation. We've seen that inflation hasn't gone as far as people are expecting, and we think there might be more hikes, so we're keeping an eye on that. But still, in Saudi Arabia, we're pegged to the dollar, of course, but we're very much focused on delivering the transformation. The plans are moving forward, and we don't see that impacting the private sector. The PMI score for Saudi Arabia in December was above 56. For the G20 average for the year, we're the largest, the highest.
And you've had the strongest jobs growth in the non-oil sector in 6 years. And the question that goes through my mind is, how sustainable is that again this year? Can we expect the same kind of growth in the non-oil sector?
Well, we've had very good numbers in terms of unemployment. Unemployment has gone down to 9.9. Female labor participation rate has gone up to 37%, surpassing our target for 2030, which was 30%. We see even in male Saudi unemployment rates, it's the lowest ever recorded. So with that said, we still want to create more jobs, and we want to even reach higher levels. The private sector is witnessing above 2 million jobs this year, which is the highest ever created.
Let's talk a little bit more about the private sector, because you've rolled the dice on Lucid and Foxconn. From where I sit, two massive moments for you in EV and in tech. Is that the key focus, or does it have to be another Lucid deal, another Foxconn deal size?
We need to keep in mind that we're doing these deals because they're important for our economic transformation. They'll help us diversify the economy and help us export more competitively. Now, these two deals are just examples of what's going on, and they're not really just about EVs. They're about the whole ecosystem that comes with EVs and technology. We're making bets for the future and for the green future as well.
Any more news with Foxconn? Anything additional to whet my appetite?
We continue our discussions with these partners and other partners, and anything coming soon will be announced.
Who are the others? You can't throw others in and then not just sort of elaborate. A little bit more on that.
I can tell you we're very serious about our diversification efforts. So we're open and we're talking to all partners who are interested in the Saudi story. The Saudi growth story is a global one.
And our global audience are tuned in, and they may well say, well, what incentives, that were there for Lucid, perhaps there for Foxconn and the metals and miners, how much more incentive are you prepared to offer to global names to come to Saudi?
We have the right kind of incentive structures and governance and processes in order to attract the right kind of investors for the right kind of returns for them as partners, for us as partners, but also for the Saudi economy and society.
In terms of the metals and mining conference that we've just seen in the past 10 days, some major CEOs there, but I've got to say, there wasn't a major amount of deals done. What role will metals and mining play in the non-oil economy?
So mining in general is one of the sectors that is growing in the kingdom. We're still in the very start of this massive unlock, if you will. In the Future Minerals Forum, there was a deal room, and a lot of discussions are going on in order to make sure that this sector and all the players in it, whether in Saudi or beyond, will see a brighter future.
Do you expect to announce a deal soon?
I can't comment on that.
Okay. The other dynamic for where you are geographically is how much do you think Saudi benefits from this onshoring, friendshoring, this movement of supply chains away from China?
Well, I think the kingdom is always seeking leveraging its unique position. The kingdom is essentially at the intersection of the world. So whatever there's opportunities that the kingdom and having operations and investments in the kingdom can be beneficial for these partners as they're evaluating or reevaluating their positioning, and for the kingdom, we'll take that seriously. The kingdom has access to natural resources, but also access to carbon removal technology, and is very serious about it. Access to a young population that's below 60% of which is below the age of 30. So many enablers that can attract a lot of partners.
One of the pieces that we wrote recently was about the Saudi first, this narrative, which is shifting, one could say more so in the oil space. But what does Saudi first mean for you? His Royal Highness Prince Abdulaziz bin Salman made the point, you're either with us or against us. For you as an economy minister, what does Saudi first mean?
We need to stop thinking in short-term or in short-termism. We need to think more long-term. And what's good for Saudi Arabia and its economic transformation and social transformation is good for the region and the world. As I said earlier, the Saudi growth story is a global one, and there's room for a lot of partners to partake in this shared future.
I'll catch up with the FDI minister, I hope, later in the week. But when I look at the gap between FDI at the moment of 0.7%, it hasn't gone according to plan. What is the biggest obstacle to getting to 5.7%, which is the Vision 2030 target?
Indeed, that's our target, and we're moving forward. Growth over the last year has been 250-something%, which is above the global average, which is around 40 or 60%. We're moving in the right direction. We've established the right regulatory reforms, more than 700. We're establishing an institutional environment, a more institutional environment, and we're focusing on this institutional clarity that will make Saudi Arabia and its economy a long-term reliable partner.
And if I said to you, as we look out onto the hills of Davos here behind us at the WEF, what is it that you want to deliver here over these 5 days to the audiences you're going to be with? What's going to be top of your agenda as Economy Minister?
We're very focused on reinventing multilateralism and ensuring that collaboration at a time of crises such as the COVID and what we saw from that kind of collaboration will continue moving forward. We're very focused on what's good for the Saudi story and Vision 2030, but we believe it will have a trickle-down effect on the region and the global economy. We're pretty much focused on finding new paths for the global economy to grow.
Do you think multilateralism will have a renaissance, a true renaissance?
I think the more institutional capability is built in these partners and stakeholders, something that we've failed to give attention to, the more multilateralism will get a fairer chance at being more impactful. But there's no other choice.
Okay, join us now with more on the interviews from Davos, of course focused on the Middle East space, and that region is Bloomberg's Manus Krani on the ground for us. Manus, a great interview, of course, some tantalizing details and nods to potential deal-making, and of course reiterating and emphasizing that they are not stepping away from their efforts to diversify this economy.
No, not at all. And, you know, the journey between sub 1% FDI and 5.6%, 5.7% is a tremendous journey. They rolled the dice. They went all in with Foxconn on a major plant deal that was announced last year. And, of course, with Lucid, which will produce electric vehicles. We know that that industry is it's in its infancy, if you want to think. Yes, Tesla's been around, but the infancy of growth in the rest of the world. So those are two big sort of tumbles of the dice, but it's very obvious that the breadth of diversification in the non-oil sector in Saudi Arabia is going to be something much further along from just electric vehicles, Tom. And I think oftentimes something that maybe the world beyond here and at home in the UAE and when I go to Saudi Arabia is 60% of that population is sub 30. You have got to deliver change. It's non-optional. You've got to deliver technology change, social change, infrastructure change, and opportunity, because otherwise you run some pretty major risks in the social space and indeed from the intellectual space of a drain. Tom?
Yeah, the risks of social unrest. Of course, Saudi Arabia has not been immune for that kind of unrest. Yeah, really interesting. Sub 30, 60%, sub 30 in the region. Manus, what are you hearing from your contacts on the ground around the Middle East? Look, it hasn't kicked off properly, WF, the World Economic Forum, but it's getting there. What are you hearing? What is the mood from your Middle Eastern contacts as they get involved in these discussions at Davos?
They're coming here as serious capital players. I mean, Tom, think about the world. Liquidity is draining out of the system. We can debate with the chart of the day. FCON is back to neutral. Liquidity, the liquidity landscape of the world is irrevocably changing. Tighter central bank policy with quantitative tightening means less overall liquidity in 2023. Francine caught up with the QIA this morning. The Qataris will deploy capital, not necessarily in trophy asset hunting, but where it fits their portfolio. I'm going to sit down with other asset owners. We'll tell you who they are over the next couple of days. The sands shift every now and then, but I've got some pretty big exclusive with one of the other asset owners here in terms of what they're doing in technology, where they're going to deploy their capital. But the interesting thing is this. Think of in Saudi Arabia, you have the PIF. In Qatar, you have the Qatar Investment Authority. You have Mubadala and Adia in my world, along with ADQ. How much opportunity do they have to fulfill the void that is capital, which is drained away from the central banks? And I would say that the number of presentations in their in-files is tremendous. So we'll catch up with a little bit more information in terms of how the sovereign wealth funds of my region, nice broad title, will indeed deploy and fill the void. Tom?
I think you just found yourself a new special series there, Manus Krani. Fantastic stuff, really, really interesting. Coming with the capital, and arguably these sovereign wealth funds have got more leverage than they've had in a long time from your region. Manus Krani on the ground in Davos. Thank you. Let's check in on these markets. You're seeing gains now across the European equity space, holding up around 0.4%, building on a record start to the year for European equities, and the technicals suggesting that there could be more upside. Recession risks starting to ease again, modestly. Futures in the US, pairing some of their heavier losses, actually. S&P futures now down just a little under 0.1%. Markets closed in the US for a national holiday. The Japanese yen trading lower by 0.4% at 128. And those natural gas futures here in Europe down 12.5%, adding to the views that inflation has started to lose its bite, at least if this trend continues around falling gas prices. The dynamics of China, of course, will be crucial for what happens across the commodity world, but gas and LNG inventories in China seem to be at a pretty healthy level. In fact, some of those cargoes are being redirected to Europe, and it is adding to some of these softer prices. And of course, the weather has been relatively mild. Across your sectors here in Europe, you're seeing gains. Top of the list, real estate up 2%. At the bottom list, travel and leisure down 0.6%. In your currency markets, the Bloomberg Dollar Index is up 0.2%. Euro dollar at 108. The sterling pound here in the UK 122, just down 0.2% on sterling, largely on the back of dollar strength. Of course, the Treasury markets stateside are closed. It's a bit of a mixed picture across European sovereign debt. And Brent at $84 a barrel. WTI back below $80 a barrel, down 0.6%. That's a check on your markets at 13:43 here in the UK, about 5 hours and 40 minutes into your European trading session. Coming up, as popularity continues to rise for ChatGPT, so do concerns. We're going to unpack that story for you, what it means for some of the big tech players. This is Bloomberg.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Welcome to Bloomberg Markets. I'm Tom McKenzie in London. Now to technology, and of course what is happening in the AI space is fascinating. AI-powered chatbot ChatGPT has gone viral, of course, in recent weeks. Gil Luria, technology strategist at D.A. Davidson, calls it the most exciting technology development in years, and he joins us now. Gil, thank you for joining us this morning, of course, LA time, where you're based. Talk to me about the implications of this technology and the risks, the concerns that are starting to mount now as the user numbers increase and people become a little bit more familiar with the potential of ChatGPT.
I think we're just starting to wrap our heads around how broad the implications are going to be. ChatGPT went into open beta only in early December, and everybody that's used it is really impressed with the capabilities. It's almost like having a conversation with a thoughtful, well-informed, intelligent person, and I don't use that word lightly, and we're just starting to wrap our heads around it. But one of the really early impressions that people have, ourselves included, is that search as we know it today is not going to stay the same. When you ask ChatGPT a question about anything, it gives you an answer. When you ask Google search a question, it'll give you several links that may help you find the answer. But ChatGPT, when you ask it a question, it gives you the answer. And that's one of the early impacts that we're going to see. There are many more. We're just starting to wrap our heads around it.
So it's transformative. It's as significant, you say, ultimately, as the first iPhone, as the first Tesla, maybe as the first time you sat down and typed something into a search engine, whether that's Google or Bing or Ask Jeeves. It's that significant. Talk to us about the concerns, though, because they have been raised, and you don't always get an accurate response from ChatGPT.
No, you don't. And that's something that happens when you Google a search something or you ask a person a question. You'll sometimes get inaccurate responses, and ChatGPT isn't perfect. It's based on let's call it on GPT 3.5, which is a very advanced technology that's used very large amounts of data, processed them and taught the system and trained the system. The next generation 4.0 will train the system on a couple of orders of magnitude more data. It'll get better, but there's always going to be inaccuracies. And there's always going to have to be some humans thinking about what's there and what's not there. I'd say in terms of the biggest concerns right now that I would think about, you have great coverage of Davos right now. What some of those folks should be asking themselves is, we know what automation did to blue-collar jobs and the impact that's had. Generative AI is going to have a similar impact on white-collar jobs. What do we do when we have a lot of people that we don't need anymore to be productive because generative AI can replace so many white-collar jobs? I'd say that's the biggest question. Then you start getting into philosophical questions about what is accurate, what is an accurate answer, what is bias? How do we see what the bias is if it's a black box, which generative AI often is? You don't know the process for how it comes up with an answer. So how do you treat bias? How do you filter for bias? These are really big questions that we're going to have to answer over the next several years.
Gil, when we move it from those big philosophical questions down to the minutiae of individual tech stocks, which tech companies are most vulnerable to the disruption that this could unleash?
So I'd say the beneficiary in our mind is Microsoft. They're an early investor. They're going to likely incorporate ChatGPT into Bing, which would make it competitive with Google search. The computations is being done on Azure, which is their business, which also means that Google and their big search business, which is most of their value, is at risk. Companies that provide call center support are at risk. Companies that provide technology that leverages artificial intelligence to drive conclusions and recommendations have an opportunity. That's what we're going to see play out over the next, I'd say, even weeks and months, because the developments of this technology are right now at a breakneck pace.
ChatGPT, of course, focused on words, essentially scripts. But there's also DAL-E or DAL-E, you can tell me what the pronunciation is, which is around images. And that, you say, is consequential from sectors like advertising all the way through to the creative arts.
That's right. Advertising agencies, marketing consulting firms, there's a lot of people at those firms sitting down, writing copy, generating images, moving images around. And all of a sudden you can ask DAL-E to just do that, to give you a full campaign. Between ChatGPT's copy and DAL-E's images, you can create a whole campaign in seconds. That's not to say a human won't have to go through it and see that there's no biases or something offensive or something that we would think is inappropriate, but they wouldn't have to do the initial work of creating the copy, creating the images. That's why we're talking about white-collar jobs that we have to rethink about, rethink their role in society and how much we need of them, because a lot of those creative roles are going to narrow very significantly to reviewing generative AI output as opposed to creating that output.
Okay, that disruption is coming, and it's time to wake up to it. That's the call from Gil Luria of D.A. Davidson. Really, really fascinating, and the call that maybe Google is vulnerable, but Microsoft could be seeing some upside on the back of their investments, of course, in ChatGPT and the people behind it and the team behind it. Thank you. Now, from big tech to the big banks, European bank earnings are around the corner. This coming off the back, of course, of mixed results in the US amid a wave of job cuts across the industry. Credit Suisse gearing up for another round of layoffs of bankers this year. For more, let's bring in Bloomberg's Charlie Wells, who's across all of these earnings and the preview for the European banking space. Charlie, what is your assessment, first of all, of the US banking earnings that have come through, where it leaves us as we look ahead to Goldman Sachs tomorrow, and then we'll get onto the question of European banks. Just give us your wrap.
You know, Tom, sometimes there's a disconnect between the financial world and the real world that Main Street lives in. And I think we're sort of seeing that play out in earnings this fourth quarter. So, you know, in that financial world, we're seeing a lot of stress with investment banking divisions within these banks. JP Morgan, they had a miss on their revenue. It was down 60%, and that really is a walloping. You saw a similar figure at Citigroup, so that's a real struggle. It's a slightly better picture when you look at the American consumer, which is a little bit confusing, maybe a little bit contradictory, but you're seeing credit card balances slowly start to creep up. Now, on one hand, that sounds like a bad story, right? It sounds like consumers are desperate, but it could also mean that consumers are confident. They're willing to borrow money. They think that they can pay it back, and they want to spend on things because they feel confident.
Okay, so there's that mixed picture. There's the disconnect, arguably, from Wall Street and Main Street, and you're starting to see maybe a little bit of caution. Yes, the balances are running up on the credit cards, but it could just see and point to consumers wanting to keep up their spending. When it comes to the European banking space, it's a very different picture, arguably. What are you looking for when it comes to those European bank earnings at a time when Credit Suisse is a bit of an idiosyncrasy in terms of its travails? What is top of mind for you?
I think this is going to be really tricky, and it's a different story, right? We have such a different economy. We're thinking about inflation that's slightly different. We're thinking about geopolitical risks, right? We're thinking about Ukraine in a different way than the U.S. Banking sector might be. But I do think it's really hard to look away from Credit Suisse, right? There was that story over the weekend about, 10% of investment bankers, being laid off in this coming year. And if you think about the number of investment bankers at Credit Suisse, that's 17,000. Now, they're largely in New York, they're in London, but there also are some smaller outposts throughout Europe. And in some of those smaller outposts, that could be a reduction of maybe a third of investment banking staff. So this is significant. And it's sort of a part of a Credit Suisse story, right? It's sort of the issue that, they had a terrible 2022. They had that major restructuring. They've lost so much. Client outflows were really staggering in the month of October. But then there is just that larger investment banking problem. And that is a theme that sort of unites both sides of the Atlantic, right? Wherever you turn, no one wants to do deals. Now, there are hints of optimism that could be coming. We're picking up on some of that in these U.S. bank earnings, but we're nowhere near a point where we're at that deal-making frenzy.
Hints of optimism, but nowhere near where you can call that this is over in terms of the route in deal-making. And certainly investment bankers will be watching for that trend and how that unfolds. Charlie was always excellent, of course, wrapping the U.S. bank earnings that we've seen so far, and giving a bit of a nod and a preview to what we can expect here in Europe. Some similarities, but also some major differences across those two spaces. Let's check in on these markets then as we come to the end of the hour. European equities continuing to hold on to their gains, currently up 0.4% and building on what has been a record start to the year for European equities. Futures in the US pointing lower by just 0.1%. The Japanese yen under pressure, down 0.4%. European gas futures continuing their leg lower, down 13%, and building that view that maybe inflation is starting to peak. A slightly easier situation when it comes to energy in Europe. Plenty more coming up, including former US Treasury Secretary Larry Summers, live from Davos. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund is typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, you ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech and sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
From London, I'm Guy Johnson. Welcome to Bloomberg Markets. Let's talk about what you need to know. US markets are closed, of course, the Martin Luther King holiday. Here are the top stories we're following from around the world. Don't bet on a rate cut this year. That's the message from BlackRock's Philip Hildebrand in Davos. He's warning that central bankers will need to deliver recessions in order to get inflation under control. Elon Musk gets a big vote of confidence from the Qatar Investment Authority, the Sovereign Wealth Fund, which, remember, helped finance the Twitter deal, told Bloomberg at the World Economic Forum that it still trusts in Musk's leadership. And how much damage has China's abrupt exit from COVID-0 caused? We're about to find out. Beijing is going to deliver retail sales, industrial production, and GDP overnight. We don't know a lot about what's happening in China right now. This data is going to give us a big clue as to how the economy is performing. Let's talk about the data that we have right now. Let's talk about the markets and how they're performing. As I say, MLK in the United States, that takes a big chunk of volume out from the rest of the world. But the Stoxx 600 continues to move higher, which is fascinating. You've got a more cautious picture when it comes to futures in the United States. You've also got a bit of a drag today for the basic resources sector. The Chinese authorities are looking very carefully at some of the acceleration we're seeing in things like iron ore, and maybe warning the market not to go too far, as a result of which miners are rolling over, iron ore's been rolling over as well. The other big feature of this week that we're going to be watching so carefully, apart from Davos, of course, is what is happening with the yen. BOJ meeting on Wednesday. Then you're going to get Kuroda coming to Davos to speak at the World Economic Forum. That's going to be fascinating to hear what he has to say. But at the moment, euro-dollar trading just a little bit higher. Critical, of course, all of this to what happens with the European economy going forward from here. The other event that we're watching carefully today is taking place in Brussels. You've got a Eurogroup meeting taking place. Eurozone finance ministers are gathering to discuss what is happening with the economy right now. The warm weather giving them some reprieve and making the European economy look significantly more robust than it did even only a few weeks ago. Bloomberg's Maria Tadeo spoke exclusively with the Eurogroup president, Pascal Donohoe, a little earlier today.
We have strongly believed that Irish interests and European interests are the same, which is why the European Commission has acted on our behalf.
It is the case that there, across the last number of weeks, a really important agreement was made in relation to the sharing of data between the United Kingdom and the European Union. And I hope if further progress can be made today, it will do two things. The first thing that it could do is finally begin to bring shape and clarity to how we can reconcile the consequences of Brexit with the Good Friday Agreement and Ireland's membership of the European Union. And then secondly, I hope progress in this area is an omen of a better and more positive relationship between the United Kingdom and the European Union for decades to come.
It's a new year, and it seems to me there may be a new mood out there. We've had Goldman Sachs drop this recession call for the euro area. Goldman Sachs is a bigger one for the time being, but also Deutsche Bank suggesting the data looks better than initially predicted, and gas prices massively down. The simple question for you today is, would you say the worst is over now?
So this just backs up what the Eurogroup has been saying for most of last year, which is don't underestimate the resilience of the euro area and the euro at this moment of economic crisis. If you looked at where we were in 2022, the growth of the euro area has been better than many would have expected, and our employment levels have been far better than many would have expected, while indeed inflation has also been higher. So I believe the euro area is in a very resilient place. We are expecting to be in a position for this year of a very low level of growth as opposed to a recession or a contraction. It's very early to be able to say the worst is over, given that we're dealing with a war. But the economic indicators at the moment, again, back up the resilience of the currency and of the economies that make it up.
So just to make it very clear, you say it's still very hard to navigate because the war, and we think about the people of Ukraine all the time here on the show, especially this weekend, which was particularly brutal in the country. But what you say from the economic perspective, you rule out there will be a recession this year, 2023, for the euro area.
Well, you're right, of course, to acknowledge the human consequences of the war, which is first and foremost where the tragedy is. But just to emphasize what I said there a moment ago, we can't be in a position that we can rule out definitively what could or what could happen across the year. But what I can say as we face into 2023 is that we finished off 2022 with economic indicators with regard to growth and employment that were very resilient, even positive, and far better than would have been expected when the war broke out. And I believe that lays the foundations for the euro area and for our economy to be able to continue to navigate our way through the economic uncertainty that is caused by this war. And principally, I do believe we will be able to secure and protect the high levels of employment that we still have within our economies.
The Eurogroup president speaking exclusively to Bloomberg's Maria Tadeo in Brussels. Let's go back to Brussels now. Maria joins us. Maria, European equity markets, European bond markets, European foreign exchange markets, suddenly loving Europe. Suddenly, the world loves Europe. We've got strong markets. You've got a sense that the European economy is going to be doing better than anticipated. Maybe this is all just based on the weather. Is there a sense of surprise, do you think, in Brussels at suddenly this turn of events?
No, Guy, and to me, they actually want to play that card up, and they want to really stress and highlight that point because everyone here, and we've seen a whole string of finance ministers walk this red carpet today, they've insisted and now say, well, the measures that we put in place, this idea of storage, this idea of telling our population this year you have to be energy efficient, the cap on gas prices, the market intervention, everything that we were told could not or would backfire in Europe, in reality did not. And then secondly, you had this weather factor that they could not have predicted, but actually helped Europe over the weekend. So, or not just the weekend, but the Christmas holidays, excuse me. And then you've had the Goldman Sachs call that really has changed the zeitgeist in many ways. You dropped that recession, and now we're seeing many names follow that, suggesting, well, if you put together the storage, if you put together where consumption has been, if you put together the weather, and if you've put together the fact that the European industry may have winked it by just by an inch, but is there, then you avoid this recession. So the message today from a lot of the finance ministers that we've spoken to is that actually Europe proved to be much more resilient than many anticipated at the end of last year.
There is another view, and JP Morgan is articulating this, and that is that Europe suddenly seems to be talking and trading like the worst is behind us. Like we are early cycle. We're in an a new economic cycle, and things are going to be improving from here. Is there a risk? Is there a risk that European politicians go too far in fixating on the positives rather than the risks?
Look, Guy, I think it's a very good question, and I put that question to, what are the risks? And what they say is that when you have a war that plays out in your own continent, it's very difficult to have the visibility. And to make it clear, what they say is that we're not going to see fireworks this year. We're not going to see tremendous growth. What we're talking about is avoiding a recession and not a deep contraction. That's essentially where the bar and the benchmark is. They also say there's a lot of things that could still go wrong, but for the time being, the impression that they get is that Europe has been stronger, and the idea of this gas prices dropping significantly, almost 80% from August, has really helped the economy. Of course, going to the future, however, and going to the medium to long term, you have a lot of issues that are still pending, especially when you look at the Inflation Reduction Act. This is something that worries a lot of people behind the scenes, and this is not about a recession or not in Q1. This is about the future of the European industry, and there's a lot of anxiety as to whether it can hold in the medium to long term.
Maria, you've also been talking to a lot of people about what the latest is on Brexit. What are you hearing?
Look, I think for the time being, not a lot, but this morning we left it in the tunnel, which if you strip away the diplomatic talk and the diplomatic speak, what it means is now you get serious, down to business to hopefully get a deal. These are not talks for more talks. These are talks for a deal. The Irish press, which is always interesting to keep an eye on when it comes to Brexit, also suggesting that there could be a joint statement, not a deal, but a joint statement with a framework of possible solutions. Now, from the European perspective, this is a way of going tick one of the pending issues, and now we focus on the big issues, which of course for the European Union, it's the war in Ukraine, what to do with that country, and the Inflation Reduction Act is really about that industrial anxiety that really you see it that cuts through the entire continent.
How far could this go? As we're speaking, Maria, Bruno Le Maire, the French finance minister, is speaking in the building behind you. He's talking about the fact that he wants significantly more state aid for some key sectors. He's talking about the idea that that state aid should include tax credits. He wants EU industrial aid to be significantly simplified. The EU has no time to lose, he says, to create a new industrial policy. How quickly can Brussels move?
And he said that for weeks, and the French President Emmanuel Macron has said it for weeks. The Commissioner for the European Internal Market, Thierry Breton, has also said it for weeks, and you see op-eds are really flourish across the European press pretty much every day, saying this is not a matter of months, we have to get it done in weeks, at least have something on paper. Now, there's a number of things going on. However, the talks between the EU and the United States continue. We need to see the conclusions for that. Some are optimistic that you could get waivers, more waivers in March. If you don't get everything, however, from the European perspective, and the EU, or excuse me, the US does not move far enough, the EU will have to move to a plan B. That is about accelerated permitting. It's about state aid. Of course, it's about changing potentially the rules, but that is also controversial within the EU because not everyone will have the same capacity to deploy state aid. And then we go back to the perennial debate of the euro area, which is, can you have a well-functioning economy that works on two speeds, meaning Germany and France get the state aid, get a lot of it, the rest, not so much.
Yep, controversial, as you say, as ever. Maria, fantastic work, as ever. Maria Tadeo joining us from Brussels. This is Bloomberg.
nearly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun.
We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
This is Bloomberg.
This week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As energy crises loom, wealth inequality intensifies, and global power dynamics dominate headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Coverage begins this week, only on Bloomberg Television and Radio.
So let's get you up to speed with what you need to know from around the world. This is the first world news. In Germany, Defense Minister Christine Lambrecht has stepped down, this after a series of missteps and days of speculation about her future. It's a blow, of course, to Chancellor Olaf Scholz's government. Lambrecht's departure comes as Berlin is debating whether to supply Ukraine with tanks to fight Russia. More problems for President Biden in the investigation of classified material. Additional documents have now been found at his home in Delaware. Now the Republican chair of the House Oversight Committee, James Corner, wants the White House to release visitor logs from the home. And there was more severe weather in California over the weekend. Thunderstorms started Saturday in the northern part of the state and spread south, causing more flooding. That was followed by yet another atmospheric river storm. Up to 3 feet of snow is expected in the Sierra Nevada. These storms are blamed for the deaths of at least 19 people. And the UK and the European Union are close to a deal on post-Brexit trading arrangements in Northern Ireland. They're also nearing an agreement on customs as well. That's designed to reduce friction between Great Britain and Northern Ireland, since the UK, of course, left the EU. Global News 24 hours a day, and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. Let's talk about one of our top stories here at Bloomberg today. BlackRock's vice chair says that inflation will now drop very quickly. However, it will be difficult to get it below 4%. Philip Hildebrand further states that central banks will continue tightening, and moreover, the markets are getting wrong in anticipating an easing from central banks. He spoke exclusively with Bloomberg's Francine Lacroix on the sidelines of the World Economic Forum in Davos, Switzerland.
Oh, very much so. I think inflation is going to drop very, very quickly. In fact, I believe many of us will be surprised how quickly it will fall. The problem is it will fall very quickly. Sort of 9 to 4 will be the easy part, and then it's going to get very difficult to get inflation back to price stability. So, but at the moment, I think the initial phase will be a very rapid decline in inflation.
So what does it mean for central banks, Philip? And you lay this out beautifully, actually, in your World Outlook. If you're a central bank, if you're like the ECB, or even if you're the Fed, do you have to be much more careful in how you manage this from now until the summer?
I think the central banks are going to continue on their tightening path. They're going to be very careful, very focused on not losing the long-term inflation expectation anchor. And so I think we're going to see, I don't see any chances, frankly, of easing this year. I think the market has that wrong. So they're going to make sure that we can really not just get from 9 to 4, but also limit any kind of risks that inflation expectations become unanchored. And because all of this is driven by labor market constraints principally, it's still a supply side story. It's going to be very difficult to get inflation kind of below 4%, let alone below 3%. So we're in the easy phase, in a sense, now of this tightening cycle.
But is there a problem with that markets don't understand that? So we have, for example, Fed officials saying, look, don't expect a Fed pivot anytime soon, but the markets keep on testing it.
That's right, and you know, I think this notion that there could be easing this year seems to be, to me, to be far too optimistic, because if you're the central bank, you're going to want to make sure that you can get this done, that you don't risk resurging suddenly of inflation expectations further down the road. So I think we're going to see at best some sort of pause, but not quite yet. And the market may need some readjusting relative to these expectations that we could be seeing some easing. And this is what we call it's a new regime. The great moderation is over. You know, this notion that when the economy struggles, central banks will ease, that was true in the past. I don't think it's going to be true this time.
And yet it's quite incredible to see actually the leverage being taken, or for companies that are leveraged, and interest rates going from 0 or 1% to where we are now without more bankruptcies. Are you expecting zombie companies to crop up?
I think it all depends how much damage will have to be inflicted on the real economy to get this last phase of the inflation being squeezed out from, let's say, 4 back to 2%. And you know, that will be the big trade-off. So this will not come without cost. I do suspect at some point the central banks will kind of back off. And not drive inflation all the way back to 2%. That might be a moment when the market can recalibrate. But for now, I see the tightening process continuing to ensure that we don't just go from 9 to 4, but can actually continue to bring inflation back under control.
So when's crunch time? I mean, if we try to put inflation 4 to 2%, does that coincide with the beginning of the summer months, or could it be later into the year?
I think we're going to see very quickly kind of dropping to 4. That's going to be, in a sense, the easy part. And then the question will become second half of the year, mid-year, what do the central banks do at that point? Do they continue and tighten far beyond what is currently expected in order to drive inflation back to 2%? I think that would entail pretty significant recessionary tendencies in the real economy, a lot of damage to the real economy. Or do they at that point say, okay, we've done enough, let's see what happens if we let inflation persist for a bit above the 2% target?
So what does this mean for markets overall?
Well, yeah,
volatility or pain?
So there will be opportunities, you know, not least in credit, in short-term bonds. We now have a very different outlook again when you look at where interest rates are. So for long-term investors, many opportunities, I think, in that space. For equities, I suspect until we know what the central banks are going to do with that residual piece of the inflation adjustment from, let's say, 4 to back to 2%, there are going to be some challenges around equity markets. You know, so some of the enthusiasm right now with this notion that the central banks could ease again imminently, I suspect that's premature. So I still see some volatility here going forward until we know how the central banks are going to handle this difficult trade-off that they face.
That was, of course, BlackRock's Vice Chair, Philip Hildebrand, formerly, of course, of the SNB, speaking exclusively to Bloomberg's Francine Lacqua at the World Economic Forum in Davos. More on this next. This is Bloomberg.
thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Welcome back. You're watching Bloomberg Markets, 23 minutes past the hour. Now, as we were just hearing from Philip Hildebrand, he is of the view that markets are getting ahead of themselves when they think that we're going to be seeing central bank cuts in the latter part of this year. Joining us now to continue that conversation is Market Live's Simon White, macro strategist over there. Simon, you kind of agree with the kind of Hildebrand starting point, i.e., yes, at some point central banks are going to be cutting, but it may not be as early as maybe markets are currently pricing.
Well, actually, no. I think they could go even earlier, because I think what happens is that when the economies deteriorate, they deteriorate very quickly. So right now we're seeing the data that's telling us what was happening a few months ago, and often that data can be revised. And when it gets revised, it's revised down quite sharply. So two things could happen. First of all, the real-time data could start to decline. Yep. But on top of that, you're starting to get worse revisions. So 3 months before already starts to look significantly worse, and that's how things can change quite quickly. Recessions they don't happen very smoothly. They happen in a very kind of like a regime shift manner. So you don't go from the smooth non-economy recession, non-recessionary economy to a recessionary
Wait, hurry up. So how does that then present itself in terms of policy making? Because at the moment the signaling is there is a gap between markets and central banks. And as Hildebrand was saying, he thinks central banks are going to err on the side of caution. How does that communication shift happen? We're about to see potentially the BOJ kind of delivering one of those shifts over the next week. How does it happen with the Fed? How does it happen with the ECB?
Well, I mean, already, like, we're having this pushback right now between the market and between what the Fed would want to happen. And kind of what the market's saying is, we don't think that the economy can handle restrictive policy for as long as you think. So, as much as the Fed wants higher for longer, the market's going, okay, well, we'll accept the medicine, but we need a spoonful of sugar in the form of rate cuts to happen sooner than you would like. So if you actually look at how long the Fed expects rates to be restrictive for, it's about 2 years versus only about a year for the market. So there's that real kind of dissonance between what the market thinks the Fed can handle, what the market believes that the economy can handle. Yeah.
Central banks, I would assume, do not want to go back to the old regime. They want to go back to a more normal regime of positive rates that they can then use to fine-tune the economy. When cuts come, how far do they go?
Well, I think if you look at, historically speaking, the yield curve is what to look at. So the yield curve is now as inverted as it's been since the 1980s. There's a very strong relationship between the peak inversion of the yield curve and the subsequent rate cuts that the Fed does. And right now, if you just purely go in the history, I'm not saying this is what's going to happen, we're looking at 450, 500 basis points of cuts, which from where peak is, would take us almost right back to zero.
Exactly.
So even if we're in that direction of travel, maybe it's 300, maybe it's 350. I mean, again, you can go by what you think is going to happen, or you can go by what the history tells you, and that's kind of like the way things are.
That's a long way to go. Simon, great stuff. Got it the long way around. Simon White, joining us from Markets Live. Coming up, precious metals under a little bit of pressure today. Gold still holding north of 1900. James Steele, HSBC's chief precious metals analyst, joins us next. This is Bloomberg.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We are seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
Welcome back. 1:30. You are watching Bloomberg Markets. Let's talk about what's happening with the precious metals complex. The weaker dollar and higher China demand certainly keeping precious metals on track for multi-month gains. This is where we are at the moment. Take a look at the screens. Look at gold. Still north of 1900. Silver at 24. What is interesting is now the increasing relationship between the gold miners and copper miners. They're basically one and the same increasingly, it feels like. James Steele, the appropriately named Chief Precious Metals Analyst over at HSBC, joins us now on the phone. James, let's talk about gold first of all. We've seen a big move up through 1900. How far does this take us? Can we get through 2000?
Well, I think it's possible to get through 2000, but the rally is beginning to look increasingly overstretched. And a number of things have been very supportive of gold, certainly in the last few months. We've had standout central bank buying, most importantly, probably dollar weakness, ideas that the Fed may eventually reverse course, perhaps later in 2023. I mean, all of those things have helped gold to go higher. But as we get up here, we are going to see increasing demand destruction, probably from the most price-sensitive elements of the market, which are jewelry. Also, this standout bar and coin demand that we've had recently as well, or for many months now, that could also take a bit of a knock at these higher prices.
Would you be a seller, therefore?
Well, I don't make trading recommendations myself, as I'm an analyst. But again, I would say that the upper end of our forecast range, published forecast range for this year, is just over $2,000, and so it does look to me as if there's much more downside than there is upside.
What about silver, James?
Well, silver has been doing very well. It was quite weak for much of 2022, but for many of the same reasons as gold, a weaker dollar, perhaps a change in Fed policy later in the year, although that's not for certain by any means, as well as very good bar and coin demand, as well as jewelry, has really propelled silver higher. I think it has a little more upside. I think it could go well above $25 because it does tend to be thinner than gold and reacts more to retail buying.
James, let me just ask you a kind of portfolio question. I'm watching hedge fund managers increasing their positions significantly. I'm watching portfolio managers broadly increasing their positions in gold. What is the case for holding gold in a portfolio at the moment? What purpose do you think it is serving? What is the kind of the central investment case for gold these days?
Well, there's two, really, and in many ways they're separate, although sometimes complementary. One is the most obvious one, which is that one thinks the market will go up, and that an analysis of supply-demand factors and your view on the dollar and interest rates might lead you to think that gold is going higher. Now, that's, of course, always an element of risk in betting whether a market will go up or down, any market. But the other reason, which I think has much more longevity and is useful in no matter what market conditions one faces, is gold's value as a safe haven and as a portfolio diversifier. You know, gold ended the year, 2022, that is, just a few dollars lower than where it started. And although it didn't rally by the end of the year, it certainly did considerably better than paper markets. And that, I think, is the true utility, the true value of holding gold. It's the insurance policy element of it. Now, if the market rallies as well, then that's an added benefit. But it does look to me as if portfolio diversification is one of the main reasons, and I think that's played a key role in central bank demand last year.
To what extent do you think, let's just talk more about that central bank story. To what extent do you think the Russian invasion of Ukraine and the subsequent financial tariffs that have been, and penalties that have been imposed on Russia, has changed the investment case for gold, particularly for central banks in countries like China? And to what extent has that got a multi-year story still to play out with?
Well, the best way to look at it, I think, is the elevation of geopolitical risk. And obviously, geopolitical risks are higher as a result of events in Ukraine and may remain high. It's interesting that even before Ukraine, geopolitical risks were rising according to the IMF and the World Bank. And each year for the past couple of years, they've been higher than the year before. And this really triggers this safe haven demand for gold. And given that central banks are rather limited in what they can buy, and they obviously can't buy equities, they're limited to the type of fixed income products and currencies that they can hold, then I think gold becomes a very convenient place, particularly if one wants to diversify a little bit out of the dollar, but does not necessarily want to go into any one particular currency. Gold allows you to be out of the dollar a little bit without committing to another currency.
Well, yeah, and I guess that's the point that maybe China is paying attention to now. It gives them the flexibility and the optionality to be able to maybe avoid the dollar. Final quick question. Bank of Japan this week, probably the last of the major central banks to sort of exit from super cheap monetary activity. If we do see that happening, is there a read across into gold?
Well, a looser monetary policy historically is positive for the gold market. Now, having said that, you know, policies around the world still remain relatively tight. Our view at HSBC is another rate hike at the end of Q1, and then steady rates thereafter. So, if some of this rally has been predicated on rate cuts by the Fed or other central banks in the second half of the year, and they do not materialize, then that could, withdraw another plank of support from the gold market.
James, great to catch up. Thank you very much indeed for joining us. James Steele, HSBC's Chief Metals Analyst. Coming up, Saudi Arabia's economic transformation. We're going to have highlights from our interview from Davos with the Saudi Arabian Economy and Planning Minister. That's next. This is Bloomberg.
you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
I'm going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It's the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome to Bloomberg Markets. Let's keep you up to speed with what you need to know from around the world. Here is the first word news. In Italy, the mafia's most wanted boss has been caught. This after 30 years on the run. Italian military police arrested Matteo Messina Denaro at a private clinic in Palermo. Messina Denaro has been convicted for dozens of murders, including those of 2 judges. A deadly plane crash in Nepal over the weekend has again put the spotlight on the country's bad safety record. At least 68 people were killed when a Yeti Airlines turboprop crashed while coming into land at the city of Pokhara. Nepal has had nearly a dozen fatal plane crashes over the last 11 years. And the US Treasury Secretary Janet Yellen will hold her first face-to-face meeting with Chinese Vice Premier Li He on Wednesday. They will meet in Zurich. The surprise announcement follows the November meeting between President Biden and President Xi Jinping. That led to a modest thawing of relations between those 2 governments. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. Now, throughout most of this week, Bloomberg Television is live, of course, at the World Economic Forum in Davos, Switzerland. Earlier today, Bloomberg's Manus Cranny sat down with the Saudi Economy and Planning Minister to talk about the future of Saudi Arabia's economy.
Saudi Arabia is today, without a doubt, the global growth story. And when we look beyond the actual GDP numbers, we're expecting 8.5 for the last year, 3.1. The World Bank is expecting 3.7% GDP growth. What we care about is actually our non-oil GDP growth, our non-oil activities, and how much we detach from oil. So we're steadfast in our transformation. We have the fiscal discipline. We have the economic transformation tools, and we're moving forward with them.
And those are very worthy headlines, but with interest rates careering towards 5%, we've got Larry Summers telling us, get ready for a tumultuous year. Are you ready for a volatile year? Can it be a year of 2 halves almost?
Well, we know that the banks, especially in the U.S. and the ECB, they're trying to increase interest rates in order to control a bit the inflation. We've seen that inflation hasn't gone as far as people are expecting, and we think there might be more hikes, so we're keeping an eye on that. But still, in Saudi Arabia, we're pegged to the dollar, of course, but we're very much focused on delivering the transformation. The plans are moving forward, and we don't see that impacting the private sector. The PMI score for Saudi Arabia in December was above 56. For the G20 average for the year, we're the largest, the highest.
And you've had the strongest jobs growth in the non-oil sector in 6 years. And the question that goes through my mind is, how sustainable is that again this year? Can we expect the same kind of growth in the non-oil sector?
Well, we've had very good numbers in terms of unemployment. Unemployment has gone down to 9.9. Female labor participation rate has gone up to 37%, surpassing our target for 2030, which was 30%. We see even in male Saudi unemployment rates, it's the lowest ever recorded. So with that said, we still want to create more jobs, and we want to even reach higher levels. The private sector is witnessing above 2 million jobs this year, which is the highest ever created.
Let's talk a little bit more about the private sector, because you've rolled the dice on Lucid and Foxconn. From where I sit, two massive moments for you in EV and in tech. Is that the key focus, or does it have to be another Lucid deal, another Foxconn deal, size?
We need to keep in mind that we're doing these deals because they're important for our economic transformation. They'll help us diversify the economy and help us export more competitively. Now, these two deals are just examples of what's going on, and they're not really just about EVs. They're about the whole ecosystem that comes with EVs and technology. We're making bets for the future and for the green future as well.
Any more news with Foxconn? Anything additional to whet my appetite?
We continue our discussions with these partners and other partners, and anything coming soon will be announced.
Who are the others? You can't throw others in and then not just sort of elaborate. A little bit more on that.
I can tell you we're very serious about our diversification efforts. So we're open, and we're talking to all partners who are interested in the Saudi story. The Saudi growth story is a global one.
And our global audience are tuned in, and they may well say, well, what incentives, that were there for Lucid, perhaps there for Foxconn and the metals and miners, how much more incentive are you prepared to offer to global names to come to Saudi?
We have the right kind of incentive structures and governance and processes in order to attract the right kind of investors for the right kind of returns for them as partners, for us as partners, but also for the Saudi economy and society.
In terms of the metals and mining conference that we've just seen in the past 10 days, some major CEOs there, but I've got to say, there wasn't a major amount of deals done. What role will metals and mining play in the non-oil economy?
So mining in general is one of the sectors that is growing in the kingdom. We're still in the very start of this massive unlock, if you will. In the Future Minerals Forum, there was a deal room, and a lot of discussions are going on in order to make sure that this sector and all the players in it, whether in Saudi or beyond, will see a brighter future.
Do you expect to announce a deal soon?
I can't comment on that.
Okay. The other dynamic for where you are geographically is, how much do you think Saudi benefits from this onshoring, friendshoring, this movement of supply chains away from China?
Well, I think the kingdom is always seeking leveraging its unique position. The kingdom is essentially at the intersection of the world. So whatever there's opportunities that the kingdom and having operations and investments in the kingdom can be beneficial for these partners as they're evaluating or reevaluating their positioning, and for the kingdom, we'll take that seriously. The kingdom has access to natural resources, but also access to carbon removal technology, and is very serious about it. Access to a young population that's below 60% of which is below the age of 30. So many enablers that can attract a lot of partners.
One of the pieces that we wrote recently was about the Saudi first, this narrative, which is shifting, one could say more so in the oil space. But what does Saudi first mean for you? His Royal Highness Prince Abdulaziz bin Salman made the point, you're either with us or against us. For you as an economy minister, what does Saudi first mean?
We need to stop thinking in short-term or in short-termism. We need to think more long-term. And what's good for Saudi Arabia and its economic transformation and social is good for the region and the world. As I said earlier, the Saudi growth story is a global one, and there's room for a lot of partners to partake in this shared future.
I'll catch up with the FDI minister, I hope, later in the week. But when I look at the gap between FDI at the moment of 0.7%, it hasn't gone according to plan. What is the biggest obstacle to getting to 5.7%, which is the Vision 2030 target?
Indeed, that's our target, and we're moving forward. Growth over the last year has been 250-something%, which is above the global average, which is around 40 or 60%. We're moving in the right direction. We've established the right regulatory reforms, more than 700. We're establishing an institutional environment, a more institutional environment, and we're focusing on this institutional clarity that will make Saudi Arabia and its economy a long-term reliable partner.
And if I said to you, as we look out onto the hills of Davos here behind us at the WEF, what is it that you want to deliver here over these 5 days to the audiences you're going to be with? What's going to be top of your agenda as economy minister?
We're very focused on reinventing multilateralism and ensuring that collaboration at a time of crises such as the COVID and what we saw from that kind of collaboration will continue moving forward. We're very focused on what's good for the Saudi story and Vision 2030, but we believe it will have a trickle-down effect on the region and the global economy. We're pretty much focused on finding new paths for the global economy to grow.
Do you think multilateralism will have a renaissance, a true renaissance?
I think the more institutional capability is built in these partners and stakeholders, something that we've failed to give attention to, the more multilateralism will get a fairer chance at being more impactful. But there's no other choice.
Faisal Al Ibrahim, the Saudi Economy and Planning Minister, speaking to Manas Krani at the World Economic Forum in Davos. Manas joins us now from the Swiss Alps. Manas, the minister, in that conversation you just had with him, talking a great deal about diversification, moving this economy away from oil and gas. It's a conversation that has been going on for a very, very long time. How far have the Saudis actually got?
I think they've achieved some pretty good headlines, you know, to get Lucid to build a factory, to get Foxconn on the ground and put shovel-ready projects. But the data is not very, I suppose, generous to him. FDI, yes, has risen over the past year, but you're looking at trying to close the gap, Guy, between sub 1% flow of FDI into the economy. The target is just under 6%. There are miles to go before I sleep, so to speak. But there is a definite sense of, you know, it's been a couple of years since COVID, since I've been in the kingdom, but there is this palpable sense of change, of social change. And with that social change, Guy, major global brands are in there now buying properties, doing deals, and whether it's hotels and tourism, which will be on the open and on the up, or on the tech side and on these mining ventures. I think the difficulty is getting global companies to commit their capital on the ground at risk in Saudi. That is the bridge they need to cross.
Absolutely. The oil and gas economy, though, has been performing quite well. Oil prices have been very high. Aramco has been making lots and lots of money. We find ourselves in a situation, therefore, I would assume, where we do have inflation to factor into the equation. What does inflation look like in Saudi, and what does it look like relative to the rest of the region?
You'd probably see Christine Lagarde take her handbag and emigrate for a period of time, maybe in the wintertime only. 3.3%, but I mean, that's nascent compared to what's the average in, I think in the G20, it's something just under 9.8%. So inflation as you and I experience it in the United Kingdom or in the US, less so in the Emirates for me, where I'm living, but 3.3% is nothing, but it is the highest in 18 months, Guy, and here's the point, which is that sort of tailwind of inflation from the rest of the world comes to root just a little bit later. That lag effect, you've seen it, you've lived in the region, you've lived in Dubai, that lag effect between what happens out there globally and when it arrives on the shores in the kingdom and in the Emirates. So to that extent, Guy, inflation is on the up. They've done subsidy moves to try and reduce the cost of living crisis, as have European nations. But it's nothing compared to Europe, but it is at an 18-month high. So the question will be, you know, everybody's asking the same question. Does it peak? Does it peak there for them and drop lower?
Manas, we're just getting going in Davos, but some great interviews so far. Congratulations on those. Really looking forward to what we see for the rest of the week. Bloomberg's Manas Krani at the World Economic Forum. So this week, we're going to be hearing from a range of speakers. UBS's CEO, Ralph Hamers. We've got Bob Prince of Bridgewater on deck. We've got the IMF's Managing Director, Geeta Gopinath, joining us as well. We've got a fantastic lineup coming out of the World Economic Forum. Stay tuned for much, much more coverage. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition long. Fasting has been done for thousands of years, of course, but we now have to move away again from these ideas of eating or fasting. They both mean very little. I've seen 110 healthy, but it's not going to be doable for the entire world population. It's going to be doable, I think, for the people that listen and follow all the right moves.
So a lot of the news this week is going to come out of Asia. Overnight, we're going to get some Chinese data. Of course, we've got the BOJ a little later on this week. Thursday, then Kuroda comes to the World Economic Forum in Davos. Now, the dollar is on the front foot when it comes to the yen today, but the euro is on the front foot right here, right now. As you can see, we're up by around 0.4%. So we're trading just shy 130 dollar yen, and we're trading euro yen just north of, or just shy of 140. In terms of the stock story, you've got basic resources lagging a little bit today, but European equities more broadly are tracking higher today, continuing a run that has really caught a lot of people on the hop. Suddenly everybody's buzzing about European equities. Interesting note from JP Morgan a little bit earlier on, though, talking about the idea that we could hit some sort of an air pocket here. They're talking about the idea that people are trading European equities as if we're early cycle, not late cycle, not going into a potential recession. Anyway, Anna Rappen, CBIZ investment strategist, is going to be joining us next to give us a take on what is happening here. We'll get her picture on whether or not you want to own the United States or whether or not you do want to focus on what's happening with Europe. That's next. This is Bloomberg.
hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy in 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like. But the more you could be you, the happier you will be.
Moment news breaks. No one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there was a lot else that happened.
But 1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
The UK is the only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority.
From London, I'm Guy Johnson. Welcome to Bloomberg Markets. US markets, of course, closed today. It is Martin Luther King Day, the holiday being enjoyed in the United States. There are plenty of things happening around the world, so let's get you up to speed with what you need to know. Don't bet on a rate cut this year. That's the message from BlackRock's Philip Hildebrand in Davos. He's warning the central banks will need to effectively deliver recessions to get inflation under control. Elon Musk getting a big vote of confidence from the Qatari Investment Authority, the Sovereign Wealth Fund, which remember helped finance the Twitter deal, telling Bloomberg at the World Economic Forum that it still trusts in Musk's leadership. And how much damage has China's abrupt exit from COVID zero caused? Well, we're about to find out. Beijing is going to deliver retail sales, industrial production, and GDP overnight. That data is going to be critical. We don't know much about what is happening in China right now. All of this information is going to be incredibly valuable because this China reopening trade is having a meaningful impact on global markets right now. And you can see that clearly once again here in Europe. The stock 600 tracking up another 0.4%. The outperformance of European equities, largely down to two factors, it seems, one of which has been the warm weather, which is protecting Europe right now from a natural gas crisis, but the other one, critically, has been that China reopening trade. Therefore, this data overnight, so important to the continuation of this trade. European stocks up by another 0.4% right now. US futures fairly flat, painting a more cautious picture, I think, going into the rest of the week. Remember, Tuesday, we continue with the narrative of US banks reporting. We're going to hear from a whole range of US banks. We've already heard from JP Morgan, Citi and Wells, Goldman Sachs, etc. on deck on Tuesday. So that's where US futures are right now. The other critical factor that we're going to be watching so carefully this week is what is happening with the Bank of Japan. Dollar yen at the moment trading just kind of cautiously. We're up by another 0.4% today on the dollar, but it's been the Japanese yen trade that has been so fascinating. The other side of that pair recently, we've already seen one big shock from the BOJ. Are we about to get another one? Kuroda is then going to come to the World Economic Forum in Davos, so we're going to get a little bit of analysis, I think, later on this week. But I want to take you back to what is happening here, what is happening in Europe, this outperformance that we've been seeing from European equities, from the European economy. A lot of banks recently withdrawing their recession calls for the Eurozone. Deutsche Bank, one of the latest to do that. And this tallies with what we've been hearing from European politicians, from European finance ministers. They've been meeting in Brussels today. The head of the Eurogroup, Pascal Donohoe, saying that countries making up the bloc could avert a recession. He spoke exclusively to Bloomberg's Maria Tadeo.
I believe the euro area is in a very resilient place. We are expecting to be in a position for this year of a very low level of growth as opposed to a recession or a contraction. It's very early to be able to say the worst is over, given that we're dealing with a war, but the economic indicators at the moment again back up the resilience of the currency and of the economies that make it up.
So European equities have been outperforming. You can only just take a look at your Bloomberg screen to appreciate what has been going on. The S&P year to date, and I appreciate it is only January the 16th, is up by 4%. The DAX, the CAC, up by nearly 9%. Can this outperformance continue? Is Europe going to remain the flavour of this month, next month, and the rest of the year? Anna Rathbun, CBIZ Investment Advisory Services CIO, joins us now to give us her take. Anna, always great to catch up with you. What do you think about this kind of the rest of the world trade, as people are calling it, this European trade that is delivering so far, and I appreciate it's early on in the year, significantly better returns? Can it continue?
Good morning. There's definitely some upside relief here being delivered by Mother Nature, and that is the mild winter that you talked about earlier, and it's helping to buy some time for our friends in Europe to sort of figure out these energy issues. The other thing was there was a large sell-off last year, and the valuations were definitely more attractive on the international side, especially for Europe than the U.S. market. So there's some relative value action here as well, but this is sort of kicking the can down the road, right? The energy issues aren't fixed overnight or just because we go from 2022 to 2023. So we have to wait to see maybe spring or summertime what the energy issues actually look like. The other thing is the ECB. There's a huge disconnect between the PPI versus the CPI, and that's because of the subsidies and a whole lot of acrobatics that are being done by the governments. And so the rate hikes for the European continent may be coming at the heels of the Fed hikes. They're a little bit delayed, but so there's a lot of uncertainties. And you mentioned Chinese economy as well. What is actually going on there is a big question mark. So I think there's still a lot of uncertainty. We can't say that we're out of the woods yet.
Nevertheless, for the last 10 years, Anna, as an investor, you have wanted to focus primarily on the United States. That has delivered good returns and better returns than you've seen elsewhere. Are we going back to that world, or do you think actually you want to have a geographically more diversified portfolio going forward from here?
Sure. We've always espoused geographically diversified portfolios because of instances like this, where the markets get excited, where you have an upward surprise than what is priced in. So absolutely, diversification into Europe, China, emerging markets, that would all be something that we would recommend.
Do you think we're sounding the all clear a little early on China? There seems to be, like, if Europe is facing headwinds, China potentially is facing even more.
Yeah, so we have to remember that even if Europe is looking better, that we still live in a global and globalized economy. So the weakness in China, definitely, I think it's an early call, and I think there's an overexcitement in the markets. We don't actually know what it looks like, and reopening has been a disaster. So I think we have to wait to see what the data looks like, and certainly weakness in the United States as well will impact Europe as well. So we have to remember that even though we're globally diversified, we're also globalized. So weaknesses in a third, I think they're thinking about a third of the global economy maybe going into a recession. That's going to have an impact on Europe as well.
Let's talk about central banks. We were hearing from Philip Hildebrand just a few moments ago, talking about the idea that rate cuts this year, which are priced in for the Fed, are not going to materialize. But the market is banking on those rate cuts to deliver the valuations that are currently being priced. Anna, do you think we're getting overly optimistic that the Fed is going to help out, that the Fed is going to deliver those rate cuts?
Let me give you a scenario. Let's say in the middle of this year, we enter a recession. And what the market is thinking is, just like in the recent past, the Fed will come to a rescue. But what if inflation still has a 4 handle? What would the Fed do? What do we expect the Fed to do? Do we expect them to lower rates? I highly doubt it. I think what is a concern at this point in time is not necessarily a recession, but a potential stagflation. So recession may be a collateral damage just to get the inflation under control.
So how do you want to invest for that stagflation scenario you're talking about?
You want to be diversified. I preach that, and I'm going to stick to it.
Okay, so let's talk about that diversification. So, Anna, let's talk about that diversification. Traditionally, it's been a kind of 60-40 portfolio that's delivered that diversification. 60 into equities, higher risk, 40 into bonds. Is that the way you want to be thinking about it? Because a lot of people I'm talking to are suggesting actually you want to flip that around. You want to be 60 into bonds and 40 into equities.
Oh, it depends on what your target is, what your goals are. Certainly either 60 or 40 or 40 or 60. It is true that bonds have become attractive, more attractive than in the past. Now, 60-40 worked before rates were 0, right? I mean, 60-40 has been a mainstay since the 80s and 90s when the bond yields were high. So I don't think it's necessarily that you need to flip them, but to recognize that bonds have become more attractive in terms of yield profile. But I would still be careful in not getting too long in duration because of the rate uncertainty coming from monetary policy uncertainty. That long end of the curve may be in for a volatile ride.
Just kind of walk me through that in a little bit more detail. This is back to the idea that stagflation is going to be the problem here, that inflation is going to be remaining elevated. Because at the moment, Hannah, in some ways, you look at the economy in the United States, and it does look like a soft landing is potentially on the cards. You have a labor market, and I saw the claims data last week, that still is holding up, and you have inflation coming down. That looks good, but you're basically flipping that on its head, saying the economy is going to slow down, but inflation is going to remain elevated.
Well, I think inflation is coming down, as we've seen in the data, and that was always our case. It's the dirty word, transitory, right? But the question is it going to come down enough for the Fed? That's the big question. The Fed is looking for a two-handle, and I think that the Fed is ready to stay high in terms of higher for longer, even if we get to 2%, just to make sure that they take care of the momentum, the inflationary momentum. So I do think that the Fed is going to continue to be hawkish, and I do agree with the statement earlier from Davos that the market may be mispricing this.
Anna, great to catch up, particularly on a holiday. Thank you so much for your time this morning. Anna Rathbone, CBIZ Investment Advisory Services CIO. What do we got coming up for you? Well, we're going to go back to the World Economic Forum in Davos. The head of Qatar's Sovereign Wealth Fund trusts Elon Musk's plan for Twitter. The QIA helping, of course, finance Musk's acquisition of the company. More on that next. This is Bloomberg.
Tuesday, a Bloomberg exclusive live from Berlin, where German Chancellor Olaf Scholz sits down with Bloomberg editor-in-chief John Micklethwaite. A wide-ranging conversation only on Bloomberg, your global business authority.
Difficult for all types of companies to find employees lately. Many people with disabilities who aren't working could be working if only given a job. About 20% of people with disabilities are employed.
Right now we're in an environment where there is a war on talent out in the marketplace. Every employer out there is struggling to find people to come into their shops and to find good, hard-working, dedicated employees. We have found through this program and other ones like it that we have within the organization that these individuals are looking for meaningful employment.
People with disabilities want to be able to live, work, and recreate in the community the same as everybody else.
Many of us identify ourselves right away by our job title. That's an important part of our image of ourselves. So that's true for all of us, whether or not you have a disability.
City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
This week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As energy crises loom, wealth inequality intensifies, and global power dynamics dominate headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Coverage begins this week, only on Bloomberg Television and Radio.
Okay, welcome back. You're watching Bloomberg Markets. I want to take you back to the stories that are already beginning to emerge from the World Economic Forum in Davos. The head of Qatar's $450 billion sovereign wealth fund says he will use the current economic uncertainty as an opportunity to rebalance the portfolio. The CEO, Mansour Ebrahim Al Massoud, joined Francis Lacroix a little earlier in the snow.
It's a challenging time. As you know, inflation is the main topic for the global economy. Central banks are trying to contain it. This means that they have to raise interest rate, which will slow the economies. Europe is in very difficult situation right now. U.S. will be in recession. China is just opening up, but they need to have a momentum. So definitely it's a challenging time, and the challenging time will continue on this year as well. But the good news that we have seen some numbers, which is promising that we are on the right path in terms of the containing of the inflation. And I hope by the end of this year and perhaps or next year, things will come back to normal.
I mean, does this create opportunities for the QIA because valuations are depressed, because certain assets are cheap? So are you adding to your investments?
Absolutely. This is always, we see this as an opportunities to really reposition our portfolio somehow. We always highlight the weaknesses that we have in our portfolio, and we wait for these sort of correction in the market to fulfill the weaknesses that we have. So definitely this is a time of reposition. It's a time to fulfill a gap and weaknesses in our portfolio, and we will always continue investing.
So how are you repositioning that? I know you were very interested in technology companies. Has that changed, or are you adding to that because of depressed valuations?
Absolutely. This is not even in technology only, but Asia, U.S. market. Technologies is something that we said that we need to chase our exposure in that market. So we are investing even in Europe, even in some other sectors, which is the venture capital, for example, where we are adding more exposure. Definitely, it's a time to redeploy and some investment in the right valuation.
So, what kind of companies are you looking for? Is it jewels or crown jewel like Harrods, for example, or things like that you're looking to acquire, or is it bigger companies?
Not really. I mean, we are not focusing on only trophy assets. When we go, we have a very fundamental process in terms of evaluating opportunities, and we embedded the scenarios that we see in the market. We are very connected to the market. We know what's going on, and we evaluate opportunities based on the fundamental aspect. So whether this is a trophy assets or non-trophy assets, we always deploy investment. If we find the trophy assets, that's fine. And the right valuation, definitely we will acquire it for our future generation.
We talked in Qatar about Twitter. You're one of the big investors in Twitter, and I feel like in the last 8 months, it's gone up, it's gone down. I mean, we talk about Twitter and Elon Musk every day.
Yes.
Where are we on that?
You always ask this question. I mean, as you know, we are an investors among a consortium of investors. We are financial investors. We engage with the management, with Elon, in terms of the plan that he has for the company, and we believe on this, and we trust his leadership in terms of turning around the company. So we are into this, and we are committed to the plan that we have made to the management.
Have you asked him to tweet less in the last 8 months? There was so much volatility. Do you get involved in those calls?
Not really. I mean, we do not really involve to that extent in terms of. Again, he has our trust, and we are sure that he would.